I'm Julie Hyman with Jared Blickery in for Brad Smith. This is Yahoo Finance Live. Let's get right to the three things you need to know to start off your morning. First thing you need to know, Federal Reserve Chair Jerome Powell, he's set to testify on Capitol Hill today, and investors will be listening closely for any clues on the central bank's interest rate plans. The testimony kicks off at 10 a.m. in front of the Senate Banking Committee before tomorrow's face-off with the House Financial Services Committee. Powell's challenge, trying to persuade lawmakers that he is committed to getting inflation back down to 2% while not dragging down the economy at the same time. Second thing you need to know, more cuts coming at Meta. The Facebook owner planning another round of layoffs that could happen as soon as this week, according to Bloomberg. These latest job cuts come as the tech giant looks to lower its overall costs and navigate economic hurdles. Its costs and expenses were up 22% in the fourth quarter, while sales dropped 4%. Meta eliminated 13% of its workforce in November in its first ever major layoff. Investors so far, they've liked the cuts. The stock is up more than 50% this year. And third thing you need to know, China is taking direct aim at the U.S. The country's new foreign minister, Qin Gang, warned at a press conference that the U.S. is on track to face, quote, conflict and confrontation with China if it doesn't soon change course. In a combative tone at China's annual leadership meeting, Gang said there will be, quote, catastrophic consequences from Washington's reckless treatment of China. This comes as the U.S. and China hit their highest tension in decades, and that was made worse last month when a suspected Chinese spy balloon flew over North America. Wall Street is eagerly awaiting Fed Chair Jay Powell's testimony today, his first appearance before Congress in 9 months. It coincides with a hot streak of economic data and stubbornly high inflation. Let's discuss what to expect with American Action Forum President Doug Holtz-Eakin. Doug, it's good to see you as always. So as we await Powell's testimony today, obviously he's trying to thread the needle here. The markets kind of come around to what the Fed has been saying, that it's going to keep raising rates. Do you think that the Fed has sort of, because it is now more in line with the market, that is a good thing, that it's sort of gotten its credibility back?
Well, I think it's a good thing that the market has accepted the reality that the Fed is going to raise rates. I mean, there were months where the disconnect between what the market was pricing for the terminal rate and what the Fed was saying were just, basis points apart. So this is good news. The reality is that the Fed hasn't made great progress on inflation. Their preferred measure, the personal consumption expenditure price index, if you look at the market-based core for that, it was at 4.9 in April of 22, right when they began the tightening cycle. It was at 4.9 last time we got a reading. So they've made no real progress on especially services inflation, and they're focused on the labor market primarily because they believe the wage increases pass straight through to be the top cost driver in the service sector. So I expect today that they will try to get him to commit to a soft landing. He can't do that. They will do their very best, but I still think the balance of odds are that late this year we have a really increased chance for a downturn as a result of the Fed tightening.
And let me just follow up to that. We get some data points later this week from non-farm payrolls. That's a big monthly employment report. And then next week's CPI. Do you think that's going to move the needle either way?
I expect the employment report will. The January employment report, I thought should be taken seriously, but not literally. A lot of those numbers just did not make any sense. The annualized growth rate of payrolls in there was about 20%, but it indicated strength in the labor market. So we need another month's data to see just how strong the labor market remains. And again, it's not that the Fed gets out of bed just hoping to put Americans out of work. What they are concerned about is the tightness in the labor market, making it impossible for them to get back to their 2% target. So that's the primary, I think, focus for the Fed. The CPI will give you one more piece of information, which is shelter inflation. Shelter inflation is the problem. It's at 7.9% year over year. It has risen every month since February of 2021. And you can't get to a 2% target if you've got 1/3 of the CPI rising at 8% per year. That has to start topping out and moving south soon, or the Fed's really got a problem on their hands.
Well, and this kind of goes to what you said earlier, Doug, which is that so far what the Fed has been doing is not working, or certainly it's not working enough. Is that something to do with the particular sources of inflation this time, like shelter, for example, like wages, for example? Is it something to do with, is it sort of more existential that the Fed's just tools are limited in general? Or, kind of how are you thinking about that?
Well, on the tools front, I mean, their tools are limited. The federal funds rate is an incredibly blunt instrument to try to slow the pace of demand in the economy. And so they push it up and see how it spreads to all classes of credit and all maturities. And that's a very imprecise process. It gets an additional piece of help here with the quantitative tightening, but that's brand new. So they don't really have a great feel for how that translates into financial tightening. So they're operating with a tool set that's very imprecise, and in some cases new. I think what they've learned is their two-part strategy: get to neutral as fast as possible, and then impose restrictive monetary policy for just as long as necessary. They didn't know where neutral was. And it turns out we aren't at neutral yet. We haven't actually gotten to the point where we're starting to slow the economy. We're not in the restrictive phase for sure. And so they're just learning a little bit about this economy and the tools they're using in 2023.
No, we are not seeing the effects of that restriction just yet. And I want to switch gears over to the budget. President Biden introducing his new budget. What can we expect here?
Well, I think you can expect more of the same. His first budget was an extraordinary tax and spend budget that took taxes to the highest levels in the post-war and spending to the highest levels as a fraction of GDP ever in the United States. I don't expect that the character of that budget to change. There will be some particulars. They're leaking out this morning that they have a Medicare rescue plan that consists of raising the Affordable Care Act's net investment income tax from 3.8 to 5% and broadening it to include more income. So they promise that will take care of Medicare for the next 2 decades. But that's really using a tool that's never been used in Medicare before. It's not a particularly good piece of tax policy. I think we're going to see more of that as we get closer to the release date.
On the flip side, as he writes about this plan today in the New York Times as well as on the White House website, and talks about that. The other side of the aisle frequently talks about that the way to save Medicare is by cutting back on programming. What do you think is the best way to address the budget shortfalls with Medicare?
The reality for both Medicare and for the larger budget is that it is these large mandatory spending programs, entitlements, that are driving the fiscal outlook. They're growing at 6 and 7% per year over the next 10 years, and we're not going to have a revenue source that grows that fast. So you're never going to get into anything that looks like a steady state until you bring that growth rate down. You can't just promise economic growth and have it solve itself. You can't tax your way out of this. And that doesn't mean cutting. It means slowing the growth of. And Medicare especially was never set up to be financially self-sustaining. 3/4 of parts B, C, and D are taxpayer financed. Only a quarter are covered by the premiums. It's responsible for 1/3 of the federal debt outstanding all by itself. So that program needs to be put on a more sound financial footing to survive in the future. And we're long overdue in addressing that. There's simply no way around it.
All right, we have to leave it there, but really appreciate your insights here. American Action Forum President Doug Holtz-Eakin, thank you for joining us. Meta is readying for more layoffs following a 13% reduction to its staff late last year. The Facebook and Instagram parent company is set to cut thousands of employees as soon as this week, and that's according to Bloomberg's. The world's largest social networking company is eliminating more jobs, and this is in an effort to strive for that year of efficiency. Meta has also been working to flatten its organization, giving buyout packages to managers and cutting whole teams it deems non-essential. And Julie, I've been reading some reactions to this, but I think overall this just gets to the cost-cutting nature and the year of fiscal discipline that I think a lot of these companies, formerly high-growth tech companies or tech-ish companies, are going through. And if we can go to the Wi-Fi Interactive right here, I just have the Nasdaq 100 year-to-date. Want to point out that Meta down here, I'm circling it now in red, that's up about 53%. That compares with Tesla up 57%, really outpacing the traditional mega caps as we think of them here, Julie. Yeah,
I mean, it also did a lot worse
last
year.
I'm glad you brought that up because
yes, it's outpaced, but like the last year for Meta was worse than almost any of the other FANGs or mega cap tech companies,
Communication services was one of the worst.
Right. I think the Meta was down something like 65% last year. So it's doing well, and its plans are being greeted in this way because investors were so unhappy with them before. And yes, of course, the Meta downdraft was part of the whole, pessimism that hit the industry and concern about overvaluation, et cetera. But it was also quite meta-specific in the sense that investors were not happy at the weight that Mark Zuckerberg was giving to the company's metaverse plans. So,
and he's not leaving those plans anywhere. I mean, they're going to be downscaled maybe a little bit, at least in the interim. But this represents a huge pivot. Meta, Facebook is as heavily into AI as Google and Microsoft are. They're a leading provider of open AI technology. So I don't see that going away anytime soon. But yes, they have to appease the shareholders. And so they're going to cut and maintain fiscal discipline in other, not fiscal discipline, cost discipline in other areas. I got a brief note here from Bloomberg Intelligence saying Meta's increased focus on Reels and WhatsApp, coupled with its cost discipline that I was just talking about, suggests improved execution in the near term. Company's lowered operating expenses and capital spending view for 2023 aids free cash flow, though its top line growth, so its sales revenue, could stay muted and continued headwinds from the ad pricing decline, echoing other social media companies. It goes on. So none of this is new, but I think these are going to be followed by cuts at other companies, high profile ones, Microsoft, Alphabet. We're not done here.
We've already had some, maybe we're in the middle, maybe we're 2/3 of the way through. Impossible to say on that front. But one little interesting personal tidbit in the Bloomberg story is that Meta is trying to present this plan to Zuckerberg before he goes out on paternity leave for his third child. So that's why this has been reported on before, we should mention. The Washington Post reported on it. There reportedly is widespread expectation within Meta that these cuts are going to happen. What seems to be new here has to do with that timing and why that timing is happening, which is interesting indeed. Well, tensions between the U.S. and China are intensifying. China's new foreign minister voiced a grim warning in his first press conference since taking over the role, cautioning there will be possible conflict if the U.S. does not hit the brake, adding that U.S. and China policy has deviated from the rational and sound track. We'll do a deeper dive into U.S.-China relations later on in the show. Well, besides the ongoing debate about whether the Fed's actions are going to send the U.S. economy into recession and stocks into a tailspin, there's been one other important side effect. The bond market is the hottest it's been in years. You can read all about it, how this is affecting not only institutional investors, but retail traders as well in today's morning brief, which I wrote on the Yahoo Finance homepage. Normally, Jared would introduce me, but I'll introduce myself. I wrote the brief. Hey. I'll take credit for it, but it was based on some conversations that we've been having.
Yes,
certainly.
It stands on its own, and it's a great piece of work. And I was surprised to see how Treasury Direct had really captured that big a portion of the Treasury market. And so the Treasury Direct, for anybody who hasn't heard yet, it's been around for over 20 years, and this is a way that individual investors can participate in U.S. government auctions, including I-bonds, which are very popular now because you can participate in inflation-protected securities. Anyway, you can see right there in terms of bills, notes, I-bonds, all just shooting up over the last few years. And this is money that's placed directly with the Treasury, executed with the Treasury, and we can just see that shooting up. It takes us into a new era.
Yeah.
The risk-free rate is shooting up. People have options. It's no longer there is no alternative. We have bonds. We do have alternatives.
And here's what's the big difference is. As you say, Treasury Direct has been around for about 20 years or so, right, in this form, where people can buy online these products from Treasury. But it's not just that, right? That the last time we saw rates at this level, there wasn't just the critical mass and usage of Treasury Direct, but there are other ways for people to buy treasuries as well that weren't around, at least did not have the same level of popularity the last time we saw rates at these levels. People can go to online discount brokerages. We talked to Sean Cruz yesterday over at TD Ameritrade, who said people are coming there to buy treasuries. And we have seen an explosion in fixed income ETFs, which BlackRock says fixed income ETFs could climb to $5 trillion under management by 2030. So those products are also fast growing in popularity. So all of that has meant that bond trading, fixed income trading, is accessible in a way it just wasn't the last time we saw rates at these levels.
Yeah, very
good. It's attractive, and people are able to get into them.
Yes, there was no liquidity in bond market products that the average investor could just easily tap the way they do now, or the way that they have access to now. Slight change here. Moving on, while the central bank remains on a tightening course, our next guest says that fixed income provides desirable cash flows to buffer ongoing volatility in the equity markets. For more, we welcome in Lisa Erickson, U.S. Bank Senior Vice President and Head of Public Markets Group. And thank you for joining us here today. Let's start with the current market environment. We've been talking about Chair Powell speaking in front of Congress in a little bit. We've got some huge economic data on the calendar. Generally, where are you seeing the markets right now?
We're modestly cautious really on the U.S. equity market. And the reason why is when we look at the landscape, there are just some ongoing headwinds facing really what's going on with stocks. The first and foremost, as you mentioned, is the fact that we've just got tough inflation. And because of that, the Fed is remaining committed to keeping that monetary environment tougher and to continue to raise rates until it's more clear that, quote, its job is done. So with that kind of backdrop, that really just makes it more difficult, not only for stocks to compete because rates are higher on fixed income, but also simply because that just makes a more difficult environment both for consumers and companies really to continue to spend and earn the way they have. So we do have that modestly cautious outlook. And because of that, really what we are emphasizing are assets that have higher cash flows. As you mentioned, fixed income is one area. And another area is also within the real assets area, an area that's called listed global infrastructure. Again, these are stocks that typically offer essential services, often can index their prices to inflation, and also offer attractive dividend yields. So another source of cash flow in the portfolio.
I want to talk a little bit more about fixed income and especially as we were just discussing the retail interest in fixed income right now. Is that something that you guys are hearing from your clients? Is that, I mean, some people who are investors right now have never experienced this in their adult lives, right? They've seen some younger investors that they've seen yields at these levels. So what's been the reaction?
Certainly yields are much more attractive now, and that is capturing people's interest. If you just look at where flows have gone, certainly overall within the industry, we've seen cash and money market funds, for example, increase. And in addition, if you just go up the notch in terms of out a little bit further in terms of maturity, some of those shorter maturity or duration funds also have very attractive yields and are attracting interest. So we are seeing increased, again, there is an alternative to stocks from clients, and we are suggesting that clients, all other things being equal, again, maintain those strategic allocation to fixed income, again, because of more attractive yields. We are cautious about maybe going out over your ski tips on fixed income only because, again, the Fed has made it clear that its job is not done. And so until there's a little bit more settling in terms of monetary policy, we advocate what would be a neutral stance in fixed income.
All right, setting aside fixed income for a little bit and talking about stocks, at least the pure stocks plays that people think about. You have a different outlook or a recommendation for clients with a shorter term versus a longer term outlook, the shorter term being a little bit more defensive. Could you just outline what you're telling your clients or recommending?
Sure. So one of the questions is for the portion that is within equities, really, where would you invest your assets? And again, for clients with a shorter term time horizon, given the fact that we've got a more uncertain economic environment and headwinds in terms of monetary policy, we believe the sectors that are of more interest in the near term would be more defensive sectors, such as consumer staples, healthcare, and utilities. They're attractive, again, because they tend to have more stable earnings over time, even in economic slowing environments. And again, they have very attractive dividend yields, so you're getting more of that return up front. However, for clients who can look out further for more than a year, we do see some interesting opportunities in more secular growth types of names, such as in information technology, such as communications and consumer discretionary portions of that. And again, what all of these more secular growth types of industries have in common is the fact that they can take advantage of tailwinds for continued demand, such as cloud computing, machine learning, anytime, anywhere connectivity. And so those should continue to bolster their longer term revenues and earnings.
And let's also talk about real assets for just a second, Lisa, because that's also an area you're recommending for investors. So what's the best way for people to invest in real assets? Is it, we're talking about real estate can be one of these areas. So I don't know if you're recommending sort of direct investment or still through an equity lens.
Well, for many clients who perhaps need more liquid investments, what we see as attractive in the real assets area is both what we would call more of a normal allocation to real estate, so listed real estate, whatever you would normally have in your portfolio to maintain that, but also, again, exposure to this other area we mentioned earlier called global infrastructure. And really what that represents are industries that really provide the basis for infrastructure for the U.S. economy, such as midstream energy, utilities, transportation, and communications. And again, what these sectors really have in common is the fact that they tend to be more essential businesses, and so have ongoing, again, more stable defensive cash flows, as well as offer very attractive income or yields over time. So again, in an environment where there could be more ongoing choppiness within the stock market, getting that upfront return in terms of a higher yield really is attractive.
Lisa, good to see you. Thanks for joining us this morning. Lisa Erickson, U.S. Bank Senior Vice President. Appreciate it. Coming up, Dick's Sporting Goods getting a boost on the back of its earnings. We'll explain why, and we'll have the opening bell on Wall Street next. Let's take a look at some movers right now. Dick's Sporting Goods beating on the top and bottom line. The retailer announcing a more than doubling in its dividend over the company's previous quarterly per share amount. The shares are going higher here this morning. You see there the beat on the top and bottom line. The company's comparable sales up 5.3% in the quarter. It's also out with a forecast, by the way. It says for the full year, earnings per share are going to be $12.90 to $13.80. Analysts had been looking for $12.03. So obviously that's a lot better than estimated. The company's gross margin is still maybe feeling a little bit of pressure. Gross margin at 32.4%. That is down significantly from 37.6% a year earlier. The CEO does say, Lauren Hobart says, the company is trying to get its inventory in order. That's something we've been hearing from a lot of retailers. And she said inventory is in great shape as we start 2023. So we'll see if they start to see that margin rebound as a result of that.
This is a company that, at least judging by the stock price, has really been executing. I've been following them over the last year or two. If we could go to the Wi-Fi Interactive, I have a couple of interesting charts here. This is our retail landscape, our heat map over 3 years. I'm going to sort by performance, and you're going to see Dick's in the upper left here. So it's number 3, up 277%. Just want to show you a chart. Let's take a 10-year chart here, and you can see it got a real huge lift early in the pandemic. And unlike a lot of its competitors, especially with all the stories about the death of the mall, was able to maintain a lot of those gains. Now, this is a 50% correction. It's steep, but not the 90% you saw in others. And this is a comparison chart between Dick's and Bed Bath & Beyond. Bed Bath & Beyond, definitely one of the post-pandemic and post-pandemic losers here. Lots of terrible execution stories from the latter. And you can see the divergence. So Bed Bath & Beyond peaked in the meme days of early 2021, and Dick's Sporting Goods peaked with the general market later that year. Like most stocks, it did fall off about 50%, but you can see it is knocking on the door of those record highs reached only a year and a half ago or so. So from the charting perspective, this is an impressive story here.
Yeah, I mean, what's interesting too is not only has Dick's outperformed other retailers in that sense, it's also outperformed the market overall.
Yes,
in terms of
big time.
In terms of getting close to reattaining its prior highs. So it really is quite unusual to see in this market, to see something like this. Now, you know, whether it's going to keep going that way, we've had some discussions on the show, Jared, about maybe not finding enough salespeople on the floor. From an anecdotal perspective, Brian Sazi and I have had some chats about that. But
enter artificial intelligence, problem solved, Julie.
I guess so. Maybe they can help my son figure out what kind of bat he needs the next time I go if I can't find an actual human.
If ChatGPT has nothing to say on it, I would be surprised.
That's true.
All right, shares of Rivian also under pressure as the automaker announces plans to raise about $1.3 billion worth of green convertible senior notes. Julie, this comes on the back of an announcement the other day. They expected previously 50,000, I believe, deliveries next year, and that was amped up to about 60,000 in a meeting, so there is some excitement over that. But these are still, you know, this is an automaker, an EV automaker still in its infancy here.
Yeah, and they sort of keep coming back and forth with that production target, right? There were concerns that they weren't going to meet the target. Then, yes, there was that internal memo that was leaked that maybe they were going to surpass the target.
Kind of Tesla-ish. I mean, it reminds me of, you know, some back and forth with respect to Tesla a few years back. I don't want to paint with too broad a stroke here.
Right. I mean, I don't know that investors have the same level of patience for Rivian that they seem to have had for Tesla over time, although certainly investors seem to throw in the towel on Tesla at various times in its history. But Rivian this morning down 7%. That has to do with the dilution here. So when a company sells a convertible bond, that bond is convertible at a point in the future into stock, which will then dilute the value of the shares. I was curious why, Jared, these are green convertible bonds. And it's basically because Rivian's an EV company. That's the reason why. So if they use the proceeds from this bond sale,
they're favorable
effectively
terms
for
somehow.
Operations, yes, that means it's a green bond. So just looking into the prospectus here and what they discussed using that for. As we were discussing, though, and I know you're pulling up Rivian on the old chart
Wi-Fi
machine there.
Here.
The stock is down about 7% year to date, I believe. So it definitely also has not participated in the upside that we've seen for a lot of other companies.
It's been very choppy. This is a sideways chart still hanging out in the bottom of the range year to date, but that's not a long period of time. Let's check out, this is 3 years, actually, I forgot. They just came to market a year and a half ago. What is it, 2 years? Anyway, there was a lot of excitement initially, and you can see that huge pop towards the opening day there when it came to market, finally listed, and it's just been a strong descent in the first part and then kind of a slog sideways to down in the second part. What I don't like necessarily is that it was finding new lows in December, while a lot of other stocks that have been beaten down were making higher highs and higher lows, and so just technically speaking, still has a lot to prove here with Rivian.
Yeah, well, it's not proven it this morning, that's for sure, as we see the stock continue to go down. We've got the opening bell on Wall Street coming in just under 30 seconds here, and it looks like futures indicating not much of anything at the open. And that could have a lot to do with the waiting game that investors are playing, right? They're looking forward to hearing from Fed Chair Jay Powell at 10 a.m. in front of the Senate Banking Committee. And there you have the opening bell this morning, Eaton ringing the bell. So as we have this waiting game, what are people waiting for from Jay Powell, right? They're looking for any hints as to what the future direction of Fed policy is going to be. He'll probably strive to not answer that question super directly, right? If a senator says, are you raising 50 basis points at the next meeting? He's probably not going to answer that directly.
No, he's going to say, wait for the Nick Timiraos article.
Right, exactly.
Please.
But we'll get some sort of intimations. We'll get some tone from the Fed chair about what he thinks the future path of policy is going to be and what he's sort of gaming out in terms of the likelihood of a soft landing at this point. But ahead of all of that action,
yes,
there's a lot of inaction, isn't there, Jared?
Wow, I'm looking at the Dow down 3 basis points, S&P 500 down 5, and the Nasdaq down 2. Russell 2000, small caps down 0.25%. So not a lot of whole action here. A lot of times ahead of these big reports or Fed involvement, could it be a Fed meeting or Jay Powell? We see a little bit of inaction or sometimes drift, sometimes to the upside. I've also seen it to the downside. Nevertheless, it looks like the market is just waiting for a catalyst. We'll get that shortly. Communication services in the lead. That's a meta story, I would believe. We'll have to go over to the Nasdaq 100 in a second to verify that. Healthcare, staples, utilities, those are also in the green. So more or less a defensive setup, except for communication services there. Energy taking it the biggest hit to the downside, followed by materials, financials. Take a look at the dollar in a second. But first, I want to check out the Nasdaq. And indeed, Meta's up about 2.5%, AstraZeneca up over 1%, Microchip up over 1.5%, but not seeing a lot of outsized performance here. I want to focus on the bond market. This is going to be the 13-week T-bill rate. This is up another 3 basis points to what is a 15-year high. Anyway, you got to go all the way back to 2007. That's going to be way over here. So higher for longer. Bond market is pricing that in, at least on the short end today. I don't know about longer, but higher definitely. 10-year. Let's dial this down to a 3-month chart, and you can see up about or down 3 basis points from yesterday's close, but still in the area of 4%. I'm going to be looking at the bond market closely today while Powell is speaking, Julie.
Yes, most definitely. And the shorter end, as we heard from Sean Cruz yesterday, has been popular with retail investors.
Yes.
As we take another quick look here at the markets, just we do see that little tiny bit of declines here, and the opening bell coverage sponsored by Tasty Trade. Let's talk about some more movers. Why don't we? We tend to get a lot of small biotech companies that trend on our trending ticker page. This is one of them today, Cara Therapeutics. The stock is down after a larger than expected miss on estimates, raising concerns on future demand. And the stock is down 26%. As I say, a lot of these small biotech companies tend to trend. We don't always talk about them. Sometimes I like to grab one and highlight it because the miss here is so acute. Look at the adjusted loss, 56 cents versus 34 cents estimated. And the revenue miss is really dramatic, just over $3 million versus the $14 million that analysts were projecting here. There seems to be some concern for about a kidney drug that this company makes, that maybe demand isn't all it's cracked up to be.
Yes, and I'm gonna focus on the charts here. I don't know how to pronounce these drug names, embarrassingly, but I have something to say about these charts. This is a 3-month chart, and yes, this down candle right here, that big red candle, stands out. But here's a max chart. This goes all the way back to, 2015 or 2014, 13. Anyway, a lot of biotech companies look like this EKG pattern where they just kind of go sideways for the most part over time, and then they have these big spike ups, and that's going to be on some good news with respect to the FDA, new product, new trial clears, something like that. And then the inevitable, not inevitable, but sometimes you get disappointments, and this repeats. It's kind of rinse, wash, repeat for years and years. A lot of biotech companies look like this, and that's that's why personally I stay away from the space. It's not for everybody. If you can manage it, the risk, and you can get into the fundamentals of each company and manage these huge swings, great, go for it. But I would prefer to take an ETF exposure to the space.
Well, I mean, it's interesting. Most of the analysts who cover this stock have buy ratings or buy equivalent ratings on it. And I'm just looking at some of the commentary this morning. Piper Sandler saying that the company has sanguine, quote unquote, commentary over demand trajectory for that kidney disease drug that I mentioned. But the analyst wonders why it's going to take so long to burn through inventory if the demand is indeed so robust for that particular drug. Another analyst over at Jefferies said that they'd still be a buyer long-term on the valuation and some expansion opportunities for some of their drugs. So we'll see what ends up happening from here. But to your point, and to the chart's point, it's a volatile one, as are many of these relatively small.
Yeah, and we've had a number of these biotech stocks pop up over the last couple of days. So we've got to switch directions here. Stay tuned later on in our show for a conversation with Sonos CEO Patrick Spence. You're not going to want to miss that. But coming up, Paramount Global is reportedly shaking up its portfolio. We're going to talk about that next. Welcome back. A possible shakeup in the media world. Paramount Global is reportedly weighing a sale of BET Media Group, which is comprised of BET Cable Network and studio streaming services BET Plus and cable network VH1. Yahoo Finance's Ali Canal has the details. And Ali, we've seen a lot of these moves. Maybe there's a little bit of consolidation going on in the industry. What are the details here?
There are talks of consolidation. That has not happened yet. This is a report from the Wall Street Journal. I did reach out to Paramount for comment. Did not hear back at this time, but a potential majority stake sale for BET Media Group would be pretty significant. Because if we take a look at this umbrella, you have the BET channel, VH1, BET Plus. Tyler Perry is one person of interest that is reportedly in talks for that majority stake. Perry does have a current deal with Paramount that he struck in 2017. That's said to be ending soon. Many of his movies and TV shows air on the BET channel. So this type of partnership would would make sense, but there are also others that are interested, like media mogul Byron Allen. He owns the Weather Channel, a number of local TV stations, and he has expressed that he is interested in this stake. So another possible buyer there. And according to this report, if this sale goes through, Paramount would maintain a minority stake as well as a commercial partnership. But speaking of minority investments, it's pretty interesting here with BET, because within that umbrella that I just mentioned, there are minority stakeholders. So Rashida Jones, for example, she's a stakeholder of BET Studios. Tyler Perry, he's a minority investor of BET Plus. So even if Paramount wanted to take BET Plus and merge it with Paramount Plus, like we saw recently with Paramount Plus and Showtime, these minority stakeholders would complicate that. So we'll see if anything happens, but right now this is early days, early discussions, nothing official at the moment.
So why would they want to sell it then? Is it because of the complications of integrating it further into the business? I mean, what's the value of this? Do we even have any idea? What can you tell us?
Well, Paramount is at this critical moment right now. They're really evaluating all the assets of their business. They're really evaluating their strategy moving forward. And I think number one is cash. Paramount wants cash. They want to really build up Paramount Plus, fund that streaming service. I will say that right now, interest rates and borrowing costs are very high. This is a very difficult deal-making environment. So I think that could be one potential threat to a deal happening right now. Maybe it would delay it a little bit, but Paramount did buy BET in 2000 for $2.3 billion. They're going to want to sell it for more than they purchased, but whether or not they'll be able to do that in this environment, I'm not quite sure as of yet. But we do know that Bob Bakish, he's very open to consolidation. He said this is something that is going to be happening across the media landscape. So I'm sure these discussions are in talks right now.
All right, selling something for more than you bought it. That's the ideal.
That's the goal.
All right, thanks, Sally. Coming up, TikTok's in the hot seat as Congress gets set to unveil a new bipartisan bill this afternoon. We've got the details and the outlook for U.S.-China relations next. China is warning of potential conflict between the U.S. and China in a more overt fashion than is typical. China's new foreign minister, Qin Gang, saying if the U.S. does not hit the brake, there will surely be conflict and confrontation. It's coming after tensions over issues like trade, intellectual property theft, supply chain reliance, and the balloons. For more on the state of U.S.-China relations, let's get to Pangea Policy founder Terry Haynes. Terry, good morning. It is great to see you. It feels like we're getting a ratcheting up of the rhetoric here. How concerned do investors or just Americans generally need to be?
Good morning, Julie. It's good to see you. My 2 cents for you is very simple. Markets don't pay as much attention to the geopolitical tensions ramping up as they probably should. And, you know, the performance of China, including this morning, their time, as you suggest, is a further ramping up of that rhetoric. They, of course, blame us for the vast majority of the things that they themselves have done, from stealing intellectual property to trying to kind of amass a sphere of influence. But putting that aside, it's very clear from the rhetoric ramping up and things recently like the idea that the People's Bank of China, the Monetary Policy Authority, ought to become more firmly under party control, and that Western accounting firms are effectively going to get kicked out of China over time. All this should make investors very concerned about the future of Chinese investment.
And let's talk about TikTok in particular. I noticed that you're assigning what I believe is a 75% likelihood of some kind of legislation eventually banning TikTok, or at least enabling that, and some high-profile members on both sides of the aisle coming together on this. Can you talk a little bit about what you think will happen here?
Sure, Jared, thanks. Bills get introduced every day in Washington, and 99 times out of 100 or more, I'm telling people not to pay any attention to them. I think this one's different. The bipartisan sponsors of this legislation are Senator Mark Warner, the chair of the Intelligence Committee, and Senator John Thune, Republican, number 2 Republican in the Senate right now. So, these are veteran guys, respected guys, people who are not, putting frivolous legislation in the hopper right off the bat, number one. They say they've got the Biden administration support. That's fine, but China policy has always been an area where there's been huge bipartisan agreement going back to even before the Trump days. So, what I look for here is I look for these 2 veteran policymakers to really put something together. And what they're trying to do, to be clear, is to do something that's beyond TikTok. Senator Warner's talked a little bit more about this than Senator Thune, but Warner's basic points are, look, we've never had a potential adversary, his words, quite like China. We are moving beyond in competition beyond national security into technology areas. Technology concerns are now part of national security concerns. And his point is, which I think is well taken, is that we need to go beyond a process where we're looking at individual companies, individual transactions, individual companies doing business in America, and do something more systemic to make sure that our technology is not infected or compromised in any way. And, frankly, people's privacy is respected. TikTok comes under that banner, but what Warner and Thune are doing, I think, is far beyond that, too. It has much bigger implications.
Terry, what is the Chinese response if a bill like this gets passed?
Well, it'll be negative and much more rhetorical. You're quite right to bring out, the people from President Xi to the new foreign minister and beyond have talked at great length just over the past few hours about placing the ramping up of tensions solely on the United States. And you got the money quote there with the idea that the United States needs to ramp down. Of course, their idea of the United States being on the wrong path, as they call it, is all about not knuckling under to whatever it is that China wants at the particular moment, and granting them a sphere of influence in Asia and potentially more. That's not something that the United States is going to do. So we're in another era of great power confrontation, and when you add in Ukraine to that, and my contention has been for some time that Russia is essentially a satellite country of China, at least in an economic sense. They're certainly not going to do anything China doesn't want them to do. So what you've got here is you've essentially got, in the immediate sense in Ukraine, a proxy war going on, but it's a but it's a much bigger conflict and much more multifarious conflict. And as Warner and Thune point out, technology is part of the battlefield now. So the United States needs a different approach.
And just back to the TikTok potential banning there, and if it goes in fact beyond TikTok, I would expect there would be maybe some privacy concerns, or at least concerns on potential overreach. How far exactly does this go, and what are some of those concerns, if you're aware of that this might go a little bit too far?
Well, sure. That's always a potential, particularly when you're dealing with First Amendment issues, and what we as a country always do is encourage the maximum amount of speech possible. Overreach concerns to the contrary have fired all sorts of controversies over the last few years, as we all know. But fundamentally, talking about a technology that compromises people's privacy, like an app or something, whether it be TikTok or something else, an app that compromises people's privacy, that steals all kinds of sensitive information and enables all kinds of other things to happen, from identification to compromising of bank accounts and so on. These are all things the United States has a legitimate interest in. And it's actually not banning speech. What you do on TikTok every day is, you could do on some other app. But it's, so in that sense, it's not really speech that's being discussed. It's whether the app has some kind of nefarious purpose that compromises national security or individual security. And, that's all fair game. And that's, I think that's going to get worked out. But, I was really interested in what Warner particularly is talking about, that he's talking about there being a more systemic approach, but to technology. So he's not focusing solely on apps, and he clearly wants to go. He and Thune clearly want to go beyond just kind of the TikTok world and assess more holistically the nature of Chinese and other country influence in the United States. So. As you say, their legislation will be unveiled this afternoon, and they've not given any detail, but it'll be fascinating to see just how broadly they cast this particular net, because I think that'll go a long way towards answering your question.
Terry, at the same time, we talked to our tech editor, Dan Halley, yesterday a little bit about the TikTok issue, and he pointed out, TikTok isn't really, and this kind of is to your point too, it's not really that different from other social media apps in terms of both the algorithm, how addictive it can be, and the sharing of information, right? So, how wide a net do you think that new legislation is? Like, is it just going to be Chinese-based companies that are affected? Is it going to be U.S. companies that are affected? It seems like that the implications of this could be pretty widespread.
Yeah, I think so. And you're right to bring that up. How I will answer you is by saying that clearly what Warner and Thune want is an approach that allows government agencies, and I'm going to guess that those government agencies include the Treasury Department and the CFIUS organization, include the Commerce Department, include independent agencies like the Federal Communications Commission, potentially others. And that they look at technology across the board. So yeah, it's not going to be solely Chinese focused or Russian focused or Iranian focused. It's going to be a situation where the technological implications for privacy and security are going to be looked at across the board. So yeah, this might be a much broader swath of concern for markets than you might imagine. And, you know, it also has the potential, frankly, to run to ground. Government is not the most quick or efficient way of looking at a lot of these problems. So, you know, I'll be fascinated to see how they want to calibrate that moving forward. I suspect that's very much a work in progress, which, at least in the short term, frankly, ought to worry markets more if there's any national security implications for publicly traded companies.
Terry, good to see you. Thanks so much. Pangea Policy founder Terry Haynes. And just a quick mention as well, Snap shares have been surging on all of this talk about a TikTok ban because it's being seen as one of the beneficiaries. The share's up 7% today. Coming up, we'll do a quick pulse check on the markets ahead of Powell's testimony.
Welcome back to Yahoo Finance Live. Let's take a quick check of the markets, which are not doing a whole lot ahead of Powell, which we're going to be covering and bringing to you all those headlines. But we can see the Dow is break even, S&P 500 down just slightly, the Nasdaq up 11 basis points along with the Russell 2000. And I want to take a longer term view of the markets here. Here is the S&P 500 over the last 3 months. Here are those big two up days. Now this week, Monday, Tuesday, we've been just kind of treading water, although elevated from Friday's levels. But I want to check out the bond market, and that's where we've seen a lot of the action recently, and specifically the 10-year. Here is the 4% line, and I'm going to be watching that like a hawk throughout the testimony today, along with some other indicators as well. And we're going to be talking with Alfonso Pecatiello in a few minutes of the Macro Compass. He's going to have some interesting insights into what we can expect today as well. Here's the U.S. dollar index up 3 months. You can see kind of in a bull flag, at least on a short-term basis, since that February low. We'll have to see what comes, if anything, from this. And guess what? We got to take a look at some heat maps here. We got communication services. That's a meta story, still in the lead. After that, staples, tech, utilities, industrials, consumer discretionary, all of those in the green and outperforming, although only slightly. And then energy down about 2/3 0.1%. Well, coming up, guys, we're minutes away from Powell's semi-annual testimony before the Senate Banking Committee. We're breaking down the highlights of the Humphrey Hawkins testimony next. Plus, Sonos is turning it up on its speaker offerings. We've got a conversation with the company's CEO coming up in the next hour. Welcome back to Yahoo Finance Live. I'm Jared Blickery alongside Julie Hyman. All eyes on Jerome Powell today as he testifies to Congress on the outlook for interest rates and inflation. We have Yahoo Finance's Jennifer Schonberger here with all the latest. Jen, please.
Good morning. Fed Chair Powell is suggesting an opening testimony before the Senate Banking Committee that interest rates will need to be raised higher than previously thought, given that economic data has come in stronger than expected. Powell will say, quote, "The latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. If the totality of the data were to indicate that faster tightening is warranted, we would be prepared to increase the pace of rate hikes." Now, the Fed projected back in December at its policy meeting that rates would need to rise to a level of between 5 and 5.25 this year, though Powell now suggesting that rates will need to go higher than that. Powell cautioned that the breadth and reversal of data from December, whether it's been inflation, the jobs report, consumer spending, or manufacturing, suggests that inflation is running higher than expected at the last policy meeting back in February. Powell reiterated that the process of getting inflation back to 2% will be a long and bumpy one. He said that policy decisions will be made on a meeting-by-meeting basis. While he said that the pace of rate hikes has slowed, he did not indicate whether that pace will continue going forward. Echoing his hawkish speech from Jackson Hole back in August, Powell said, quote, "The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done." Now, in questioning this morning, Senate Republicans will be focused on the Fed's reassessment of banks' capital requirements following a letter sent by ranking Republican member Tim Scott to Chair Powell last week. But Senate Banking Committee Chair Sherrod Brown cautions in his opening statement against raising interest rates too high. He says there are other ways to bring down inflation than raising rates. Brown points to strengthening supply chains, boosting manufacturing in the U.S., and rebuilding infrastructure. He says, quote, while there are times when the Fed must act, we cannot risk undermining one of the successes of our current economy. For the first time in decades, workers are finally starting to get a little power. He points to unemployment at that historical low level of 3.4%. It all begins playing out in minutes, guys.
It is beginning, and we're going to keep on it as well. Thank you for that, Jen Schonberger. All right, the Fed remains committed to returning inflation to its 2% target, as Jerome Powell points to interest rates likely higher than previously anticipated. So where does this leave Powell and his credibility and the path forward for rate hikes? Here to discuss this and more is Alfonso Pecatiello, the Macro Compass founder and CEO. Alf, as I call you, because that is your Twitter handle, Macro Alf. Great to see you. We've done webinars together, and you have some amazing macro tools at your fingertips that you have brought to the masses. You've been listening to some of the comments about this latest Powell testimony. Stocks, by the way, are off on the news. Just what's your biggest impression here?
Look, Jared, thanks for having me. First of all, it's a pleasure to be here with you. I think Powell is trying to reassert what I call his Powell credibility indicator. So that it basically tells what the market is understanding the Federal Reserve stance will be. And the market is understanding it's going to be pretty tight for a pretty long period of time. So the Powell credibility indicator is nothing else than measuring where Fed funds adjusted for inflation will be a year from now. Because in every instance in the past where the Fed had to bring down inflation, it did so by raising nominal Fed funds rate well above the level of prevailing inflation rates. And that's what the market is pricing in right now, with the real interest rates a year from now priced at over 200 basis points. That's a very high positive real interest rate, which means the market is believing that Powell will not stop tightening policy until he gets the job done on inflation.
Well, maybe markets will believe him, but I want to show another chart here that you've supplied us with. This is global credit, and this has a lot of immediate implications and also lagged implications for the market and economic growth. Here we can see this light blue cyan histogram. This is GDP for the G5, and this is lagged, and it's a year-over-year comparison. And then we have the Market Compass Global Credit Impulse in purple, and this purple line has crashed recently over the previous quarters. By the way, this goes all the way back to 2006. So what does this crash in global credit mean for the markets and for the economy in the coming months?
Look, Jared, this is one of my flagship macro indicators. It's the Macro Compass Global Credit Impulse. What it does, it basically looks at the 5 largest economies in the world, and it tries to measure whether we are creating money for the real economy or not. And so this indicator has gone negative, as you had shown there, because fiscal stimulus has basically stopped. And also credit creation for the private sector has come to a halt because borrowing rates are just unaffordable. So as credit dries up, as that chart shows, with a lag of roughly 4 quarters, GDP growth also comes down. And the credit impulse now is as negative as it has ever been. It's basically the same negative level as heading into the great financial crisis. This suggests that GDP growth will turn negative. In other words, that a recession is the base case for global macro economies starting from late summer this year. Markets are not prepared, I believe, for a recession. The bond market is pricing the Fed to remain tight, interest rates to be still over 5% in a year from now. That cannot happen if a recession is unfolding. The Federal Reserve will be forced to cut interest rates, and the equity market, at the beginning especially, will suffer from an earnings recession, which isn't yet fully priced in.
Alfonso, it's Julie here, but doesn't that also suggest that what the Fed is doing is working? In other words, that we've had this sort of disconnect, right, where some charts of financial conditions show them loosening. The Fed chair, Jay Powell, has maintained that they're not. They are, in fact, tightening. What you're talking about with credit also suggests that they're tightening, does it not? So it suggests that what the Fed is doing should be working.
Great points. And yes, it is working. The thing is, the lags in this cycle have been a bit longer than usual. Take, for instance, construction employment. So the labor market is one of the reasons why we get a lot of headlines that the economy is still very strong. The reality is that normally at this point in the cycle, with housing activity having slowed down so fast, and this is an outcome of what you just discussed, of mortgage rates being very high, of tighter financial conditions, When the housing market stops this suddenly, as it did this time, normally you get construction layoffs to a very large extent, and they lead wider layoffs in the labor market. Construction employment is still positive on a year-on-year basis, which means basically the lag in this cycle seems to be a bit longer than people are used to, but it doesn't mean we are not going to get that effect. So I guess the Fed is actually doing what they're supposed to do, which is to slow the economy down. The problem here is that as credit has dried up really aggressively, the issue is the longer we wait for the downturn, the higher the probability the downturn is going to end up being worse.
And just along those lines, I have one more chart on the Wi-Fi Interactive that I want to direct people's attention to here. This is the higher for longer sweet spot is coming to be in 2024. So this is the Fed funds term structure today, and this is in purple up here. And then we have it in cyan. That was 1 month ago, basically February 1st. And you can see how it's shifted higher here along the entire curve. What is this saying to you?
Look, Jared, on the macro compass, I really like to track the bond market. I've been a bond trader myself for years before opening up the macro compass. So the bond market here is trying to absorb the information from the Federal Reserve that the Fed is going to remain tighter for longer. And what this means basically is that all the interest rate cuts, which were priced into 2024, especially the first half, are now getting repriced away. Fed funds future by March 2024, so that's a year from today, guys, are still priced above 5%. 5% Fed funds rate for 1 year, starting today, effectively, for the next 12 months. Those are very tight conditions that are to be kept there for longer because this is the new Fed reaction function. Again, the issue is, as Julia highlighted before, is that the tighter you keep borrowing conditions for the private sector, the higher you keep mortgage rates, the higher you keep corporate borrowing rates, the higher the chances you're going to freeze these credit markets and basically sleepwalk into an accident or in general accelerate a recession later on.
Right now, Alfonso, we are seeing stocks fall, take a leg down in the wake of these comments. As Powell's talking about the ultimate peak, the end peak to be higher than expected. As you talked about, the market's not pricing in the scenario that you're painting. Stocks are down today. They're not down that much, right? The Nasdaq's down 0.9%. I mean, what kind of decline ultimately would you foresee if the market's pricing in if what you're talking about happens? What would happen to stocks?
Look, I believe that a modal outcome for the S&P 500 could be a retest of the lows, so around 3,600. And the reason why I don't think it's going to be much lower than that is that the stock market generally bottoms before earnings bottom. So if we are going to get into an earnings recession, which I think has started and will continue, earnings will continue to decline, but the stock market at some point will start going up. And why that happens is when earnings start to decline, they're, let's say, in the mid part of their long-term decline in a bear market, the Federal Reserve normally capitulates. And the Federal Reserve generally cuts interest rate about 400 basis points in a recession. So, and that will mean cutting rates from 5.5% terminal rate today to 1.5%, 2%. But as the Fed does that, it starts getting incorporated into better valuations. So even if earnings keep declining, valuations don't decline anymore, which means the stock market can stop its decline and start slowly but surely moving into a new bull market. That's why I think we are going to retest the 3,600 lows. That's at least my base case, but I don't think the S&P will drop way below that. It's still, I mean, we're talking about over 10% below where we are today. And I agree with you that the market is very complacent at the moment to this confluence of very tight credit and monetary policy being priced in against a very likely slowdown in economic activity ahead.
Alfonso, great to get your perspective today. Really interesting stuff. Alfonso Peccatiello is Macro Compass founder and CEO. Thank you.
Thank you for having me.
Let's take a look at shares of Squarespace, moving to the upside after topping revenue estimates, growing 10% year over year. Its unlevered free cash flow saw a 217% increase. The shares are up about 8.5%. The web hosting service did see net loss expand, or actually posted net loss versus a profit a year earlier because of a non-cash goodwill impairment charge of about $225 million. A bright spot in the first quarter revenue outlook as it came in above analysts' expectations. Well, coming up next, we're going to be focusing on energy, why America may be more energy independent than ever. Yahoo Finance's Rick Newman has the details.
Consumer confidence decreasing for the second month in a row in February. The index falling to a 3-month low on worries over a possible recession. A decline entirely driven by expectations for the future. That means U.S. consumers keep feeling better about today and worse about tomorrow. We've got to talk about retailers, too. They're remaining cautious as inflation weighs on consumers.
We're just seeing a consumer that's making choices as they've seen the persistent inflation in a category like food and beverage, and that's taking a bigger piece of their share of wallet, and that's factoring into their purchase decisions.
I was at Costco this weekend, and let me tell you, those lines were incredible. As the consumer continues to gravitate and stick to those where value is everything for the consumer right now, they're looking for any way to save a penny.
Disinflation, like the Fed is out there talking about, is not necessarily happening. These companies are still dealing with high levels of inflation in their supply chain, and their customer base still dealing with high levels of inflation.
It's also a very bad macroeconomic situation right now where the consumers have shifted their spending. They're moving away from discretionary and sticking to staples. As a result, it's not the best scenario for the department stores in 2023.
I think the premium, the wealthier consumers are still doing well, and they're still pricing up, so to speak. Whereas the middle income and lower income consumers are not only scaling back some of their purchasing, but some of the features, some of the add-ons, some of the more premium components of leisure spend are beginning to tail off.
Let's do a quick check of the market, sponsored by Tasty Trade. And of course, in the wake of what we just heard from Fed Chair Jay Powell, who seems to be banging the drum here. Yes, rates are likely going to have to go higher if the Fed needs to keep inflation under control. Powell saying the ultimate endpoint of rates will likely be higher than the market's anticipating. So stocks are down. They're not down that much, considering what he said. We're seeing the S&P and the Dow off by about 0.75%. The Dow down by a little more than 0.5%. Let's also take a quick look at commodities. After weaker than expected trade data points to China reopening isn't quite as robust as large as expected. Joining us now, Yahoo Finance's Inez Ferre. Hi, Inez.
Hi guys, yeah, that's right. And despite those lockdowns being lifted, you had weaker than expected import-export data for China. So that is having an impact on crude oil. Also, the US dollar going up above 105. So that's also putting some pressure on oil prices. We're looking at WTI that's down more than 1%. WTI had been up for the last 5 sessions. But if you just take a look at a year-to-date chart, you can see kind of a trading range right here, around $10 trading range for Brent crude for year-to-date as well. Today, Brent crude is down about 1%. Do want to point out also natural gas, which had been down yesterday, seeing a little bit of a rally up. And then just pointing to some of the metals, copper futures at around $4 a pound, down 2%. China is one of the biggest importers of copper as well. So when you have concerns about recessions in the US and Europe, about demand concerns in China, despite the reopening there, you're going to see commodities lower as well, guys.
Thank you for that, Yahoo Finance's Ines Ferre. And I just noted crude oil having its worst day in about 2 weeks here. And it is a sweet time for crude, well, light sweet crude, especially if you're an American. The nation is more energy independent than ever. Here are the details. Yahoo Finance's Rick Newman. What are those details?
Consumers might not think this is happening because gasoline prices, they're down from $5 a gallon where they were last summer, but they're not as low as they were before. But when you look at the production data, it's kind of remarkable what's happening in U.S. energy markets. We're going to hit a new record high for crude oil production in the United States this year. We're going to hit a new record high for natural gas production in the United States this year. And when you look at net imports of energy to the United States, we have been actually exporting more energy altogether than we've been importing for the last 12 months or so, and that has never happened before for that long. So if you this concept of energy independence is kind of complicated. It's a bit of a misnomer, but one really good way to measure how dependent we are on foreign energy is our net imports, which are now negative. So we have been selling more energy to the world than we've been taking in from the world for the last year, and that is really good news for this industry, and it's pretty good news for consumers here.
And as you say, it's great news. So how does this square then with, what else we're hearing in terms of rhetoric from the administration?
I mean, this really is what you would consider to be a good news story for the U.S. economy, but I don't think you're going to hear anything about it at all from the Biden administration because Biden's biggest priority with regard to energy, of course, is the green energy transition. He signed that big bill to, subsidize green energy last year, the Inflation Reduction Act. And Biden has kind of been trash talking fossil fuels. I mean, as a candidate, he said we want to get rid of fossil fuels. He's been in kind of this rhetorical war with the industry. He won't really cozy up to the industry, even though he wants them to produce more. So the irony here is that Biden is actually getting what he wants from the U.S. oil and gas industry, which is more production. They're producing more because it's in their interest. Prices are high enough for them to make more money. They are making good money. So we're getting more fossil fuels. Keep in mind, there's a lot of turmoil in energy markets because of Russia's invasion of Ukraine. While we're seeing, and by the way, U.S. now the biggest exporter of oil in the world. I mean, think about how different this is from 10 years ago. But Russian oil is starting to come off the market, so the global supply of oil is not real loose, and China, as we've been talking about, is coming back online after those COVID shutdowns. So energy markets are still kind of tight globally, but the United States is a bigger contributor to world energy markets than it has ever been.
Ultimately, what are the implications of this for the green energy transition?
I think it's almost irrelevant to the green energy transition, in my opinion, because
they can be on two separate tracks, but still be moving forward.
The problem with the way many people have framed this is it's as an either or.
Right.
That we need to get away from fossil fuels so that we can have more solar and wind and renewables and things like that. We're going to have fossil fuels for 50 years, if not longer. And in fact, natural gas is really the linchpin of the transition to green energy because we need natural gas as the base source of electricity in order to install more renewable. Because when you don't have solar, when you install solar and you're getting your electricity from solar, when you don't have the solar power, when the sun is not shining, what's your backup plan?
Right.
The backup plan is natural gas. It's called the base load. You have to have a reliable source of energy when the wind doesn't blow and the sun doesn't shine, and that's natural gas. So we're going to have oil and gas for a long time, and we are also going to have more renewables as a percentage, a higher proportion. It's going to keep going up as a portion of where we are getting our electricity, for instance. That is the transition. It's just going to take a long time.
Yeah, and just taking a look at natural gas chart on the Wi-Fi Interactive here over the past year, you can see down 45%, but most of that decline coming this year. And if we change that to a year to date,
it hasn't been a very cold winter. That's part of that, right?
So everybody talks about gasoline prices.
Yes.
In a way, natural gas prices are more important because they determine electricity, and they are a huge factor for businesses and for manufacturing. And everybody has gotten a break on natural gas. I think prices are down by more than half, by more than 50% from where they were, let's say, a year ago. We've had elevated natural gas prices for the last 2 years. A warmer winter has been a huge help. But we are also seeing more production. I mean, more production from the United States, and that U.S. gas is also, again, gas export. U.S. gas exports are a big deal, and that is a big help to Europe, which of course is transitioning away from Russian gas and has gone from getting about 40% of its gas from Russia to getting less than 10%. A lot of that replacement gas is coming from the United States. So Europe didn't freeze this winter. That's good news. We're not out of the woods, but natural gas is back.
Yeah, and U.S. is swing producer here.
Right.
Thank you for that,
That's
Rick
right.
Newman. All right, coming up, California is cutting ties with Walgreens. Yahoo Finance's Anjali Khemlani has the details. Up next.
California Governor Gavin Newsom now says the state will not do business with Walgreens due to its position on not dispensing abortion medications. The pharmacy giant says it will provide those medications in jurisdictions where it's permissible. It seems the damage has already been done. There's a lot to unpack here. Yahoo Finance's Anjali Kamlani has the latest for us here. You know what? Rather than start with California, I'm going to start with Walgreens.
Okay.
I'm going to flip it on its head here.
Fine.
Because what is Walgreens doing?
Okay, so here's where the story kind of got mixed. Last week, we got reports from the Kansas Attorney General who released a statement saying that Walgreens has agreed not to sell the abortion pill, one of the 2 abortion pills that are used, mifepristone, in Kansas. That is important because that is just Walgreens' response saying, we acknowledge your state law and that we're not going to then sell in your state because it is illegal and there was threats of lawsuits. So what Walgreens is saying is we are not selling in states where it is already illegal and where there are abortion bans. However, we are going to be applying to dispense in states where it is legal. And that includes not using mail order for those states where it is illegal. That's what Walgreens has said. And you can see it clearly. We obtained an internal memo that CEO Roz Brewer sent to employees. And it does say very clearly, we want to be clear about what our position has always been. Walgreens plans to dispense in any jurisdiction where it is legally permissible. And then saying that once they're certified by the FDA, which could take several months, by the way, they do intend to then be in those states where, again, where it's legal, but also saying that they, quote, do not dispense where it is illegal. So they're being very clear that they're just trying to follow state law. Now here's where the issue kind of splits. Some are wondering whether or not, because the mail is under the federal jurisdiction, they could in fact go around that. That's not clear, and that's part of where some of these lawsuits come in that have been going on. And so that's the question that is still really on the table, is what can be done? What options do Walgreens and CVS have when it comes to states where the abortion bans are in place and potentially going to be in place?
So it sounds like they're not trying to take a political stance, but nevertheless, that is the interpretation because we're all human here. And how does this fit into what California is doing?
So that's where California comes in. That's where Governor Newsom read the headlines, which said that Walgreens was stopping dispensing, which they already are not. So that's the first problem. But he did say, quote, that he will not do business with Walgreens or any company that cowers to the extremists and puts women's lives at risk. Now, Walgreens is like we just mentioned, not doing something. It's just, trying to follow state laws. Now, what Governor Newsom is saying is that because of that stance, because the headlines are reading that Walgreens is stopping and responded to the attorney generals in the affirmative, sounding like they were acquiescing to the threats, the governor is now going to look at all the business it does. That includes through Medi-Cal, the Medicaid insurance, as well as potentially this could affect in the long run if this does stay in place, if he makes good on the threat, the drug manufacturing business that they're trying to stand up, which is that generic drug production that California has been looking at for the past year or so. And so once that builds up, obviously they would look at the Walgreens and the CVS's of the world to be part of that distribution process. And this could affect that in the future. Now, that's where sort of the long-term view is. Now, Walgreens is not the only player in this. Obviously, we know CVS, Rite Aid, Target, Walmart, and the like, potentially even other mail order services like we know Hims and Hers, and those. We haven't heard from any of these. So the question is, where do they all fit into this? How many other online pharmacies are going to be able to bypass some of these state laws if they are able to? And what the process will be there. So it's really, like we said yesterday, developing story, still a lot of time, on the table because of the FDA certification.
All right, well, we'll be checking back in with you then. Anjali Kamlani, appreciate it. Well, coming up, there are some new smart speakers in town. We're going to speak with the CEO of Sonos on the company's launch. There he is, Patrick. We'll talk to you in a minute. Oh, with the speaker. We'll be right back. The last few years have been more than challenging for the tech space, and smart speaker maker Sonos was no exception. Bottlenecks from supply chain disruptions have since eased, though, and everyone seems to be awaiting a tailwind from President Biden's CHIPS Act. All this could mean good news for the company, and it's dialing up its offerings with the launch of its newest smart speakers. So what does all of this mean for the stock? Sonos CEO Patrick Spence is joining us now, along with Yahoo Finance's Brian Sozzi. And man, Soz has been waiting for these speakers, Patrick. As you know, every time you've come on, he's been asking you for information about them. So there are new shapes to these speakers. There are new features for these speakers, including connectivity. What's sort of the big headline that you want people to come away with when they're looking at these new offerings?
Innovation. We're raising the bar once again on the industry, and we've done something that's a first for Sonos, which is introduced two products simultaneously. So the team has really outdone themselves with the Era 300. You're talking about the best spatial audio speaker in the world. And you really see that form. It's a bold new design. And the Era 100 is really the remastering of our iconic Sonos One, which remains our top seller and has really been the industry's top smart speaker. But, we still thought there was an opportunity to reinvent that. So we've done that from the bottom up. And these products are incredible. I can't wait for you guys to hear them and really feel the sound that comes out of them.
Patrick, why is the shape different?
Yeah, so Brian, this is a classic case of form following function. So with spatial audio, really you need the height channels and you need to start from scratch. So you can't take, a previous speaker and just try to, jam in like the new codecs and that kind of thing to really create that immersive feel and feel the sound. And so we started from the bottom. We made sure that it would be able to deliver that feeling of being in the center of the music. And you've got to hear some of the tracks that people like Phineas have actually, tuned for spatial audio. And they're just so brilliant in terms of the way that they actually feel.
Patrick, I've invested a large sum of money in a large number of Sonos speakers. I've told you this repeatedly, and I'm not alone. Many other people have done the same. How are you going to convince them that they need to start upgrading, in my case, 11 speakers?
So I know you can take those 11, give them to Julie, and then.
Oh, I already have them also, Patrick.
He has them too, and that's part of the best point here.
So look, the best thing about Sonos, and one of the things that we're most proud of, is over 90% of the products we've sold over the last 20 years remain in service today. And, I think that's a testament to the quality of the products, the longevity. And so we really hope a lot of customers, and we know if history is any indication, a lot of customers will come and add these amazing new products to their system, but they'll move the other ones to another room or perhaps give them to a friend or family member. And so we think that real flywheel works here. And, you don't have to get rid of any of those products. Pass them along to somebody else that can enjoy the Sonos sound.
Jared here. I'm Sozzi. I could use 11 speakers.
I got you, brother.
Thank you.
I'm giving you five.
Thank you so much. I'll take half. Seriously, I want to know how you think about your competition. You have the traditional audiophile space where you have these nice speakers, nice hardware, and then you also have the smart devices like Alexa, you have Siri, and those don't necessarily have the fidelity that yours does. How do you think about your product with respect to the audio engineering that goes into the tech, but also the AI component as well?
Yeah, great question. I think the legacy players we've competed with, we've really disrupted the market, right? And we did that because we are the story of software eating audio. Then the big tech players jumped in and, they all had different strategic reasons to get into the space. And a lot of it was kind of mixed. It wasn't about providing great sound and doing it in a brilliantly simple way. And so we've done that. And, our Sonos voice control that we introduced last year is really focused on music and getting you quickly to the music that you want to listen to. And behind that is machine learning, AI. And I think that in a world where, there are tens of thousands of tracks getting uploaded to Spotify, Apple Music, Amazon Music every day, there's a opportunity really, and this is a bit what we've done with Sonos Radio, to really curate for people. And that's where AI, machine learning, some of those things come into play. You saw last week Spotify doing an AI DJ, these kind of things that will help really get people to music that they like a little bit quicker and not have to deal with the massive amount of choice that's out there.
Patrick, on the sort of competition front, I also have a compatibility question because I know there's some litigation ongoing. There's also talks ongoing between you and some of the other tech companies as to the compatibility of the devices. Any movement on that, especially with these new products coming out?
The one thing I would note is that continues the new products support Amazon's Alexa, obviously Sonos voice control, but they do not support Google Assistant because Google changed the way that they are doing the technology stack for voice. And it's a heavy engineering lift. And at this point, we're kind of hoping they go back to using the old approach. But that's not a Sonos specific thing. That's something Google's chosen to do. I think voice in general right now is kind of in that, if you think about Gartner's hype cycle, it's kind of in that trough of disillusionment. And I think we're finding with Sonos voice control, the highest net promoter score and as well, like really heavy usage because it's very focused on music and it does music very well and it's private. And I think we will see voice take on a bit of a new life thanks to what's happening with AI and ChatGPT and some of these things. But right now it feels a bit like it's in a trough of disillusionment if you look at a lot of the articles and pundits in terms of what they're saying. But for us, it's a great way to get people to the music they love very, very quickly.
And Patrick, while we're discussing these new speakers, these are expensive products for a lot of households. And they come at a time, today at least, when we have the Fed chief, testifying, talking about inflation, higher interest rates. You have lawmakers voicing concerns about the state of household budgets. Two-part question. What is the inventory commitment for major retailers for products like this against this uncertain economic backdrop? And do you see, how promotional do you expect to get for some of these products?
Yeah, so we've got great commitments from our retailers, and you'll see some, excellent promotion of these products, but not in a price way. We are very disciplined in that type of approach. We are not a promotional type of brand. And I think, Brian, if you think about the products and you think about their 10 plus year lifespan, for the one, that's $25 a year. For the 300, that is $45 a year. You break that down on a daily or monthly basis and how much these products get used. We think it's a lot of good value for the money. They're expensive as an upfront, but they last a lot longer than anything in the industry. We continue to upgrade them. We continue to bring new services to them. So I think at that price point, it's a value, and we'll. Certainly it remains an uncertain time, economically, but these products as well will be around for years, right? And we build for the long term. So we are very confident that over the long term, these products will be as successful as all of our products have been.
All right. And I look personally forward to putting that test to the use here. Hopefully I get those 5 speakers signed.
You will.
You will. Thank you to Sonos CEO Patrick Spence. All right. And Brian Sazi as well. All right, coming up, we have Norfolk Southern. They're announcing new safety measures following its train derailments in Ohio. We're going to discuss that up next. Welcome back. Norfolk Southern has announced some revamped safety measures, including updating its hot bearing detector network as part of a new 6-point safety plan. And this comes in response to a toxic train wreck that ravaged the town of East Palestine, Ohio. And for more on this, we welcome in Lee Glasgow, Bloomberg Intelligence Senior Analyst of Trucking Logistics. And could you give us, please, just a brief update of what's going on the ground there?
Yeah, sure. So, it's really, a moving target right now, to be honest. I mean, the regulators are doing their work, seeing, what's going on, what necessarily caused the accident. There's some preliminary reports that, it was an axle that overheated and caused a derailment. And then you also have, the other regulatory agencies like the EPA going in and making sure that the railroad is cleaning up the spill that happened following the derailment. Norfolk Southern has answered, obviously, under a lot of pressure with the 6-point plan, like you mentioned. A lot of that has to do with investing in its own infrastructure, something that it does do already. What I would say is, for your viewers is that, operating a railroad is not an easy task. It's done outside. There's elements, and sometimes those elements are extreme. When you're moving heavy equipment across, networks like that, sometimes failures are bound to happen. It's up to the railroads to minimize those numbers of failures. I think that the 6 points that the Norfolk Southern has released, I believe it was yesterday, will go a long way in improving the network and the overall safety of the network. Because at the end of the day, Norfolk Southern is a public company, and it does want to obviously maximize its returns that it can do. Safety does make money. So when you run a safer railroad, it's much more profitable than if you run an unsafe railroad. Because if you're dealing with derailments or accidents or other issues, your trains are not on time, they're not efficient. If your trains are not on time, you're not being able to be competitive with other modes like trucking. So the railroads have a vested interest in becoming, as safe as they possibly can. And so what they're doing is they're investing with these things called hot boxes, which are, if you've ever seen a railroad, there's these little silver huts going across the network. And what's next to those little huts are these little devices that will measure the heat of the axle bearings. And when it gets to a certain temperature, it'll alert the crew. What happened is in this accident in East Palestine is that it got to a certain threshold. The train crew slowed down the train, and by the time the train stopped, it was a little too late, and a failure happened, and the train derailed. So they are investing in that, and that it'll probably cost them about $40 million for the 20 additional the 200 additional hot boxes that they plan on deploying across the network.
So Lee, I mean, obviously it's in their interest to not have stuff like this happen, but then, in a perfect world, none of this stuff would happen, and they would have already invested in all this stuff before the derailment happened. But, given the cost of addressing all of this, not just for them, but maybe for other railroads as they're looking at the situation, wanting to also avoid it, what's the investment case for Norfolk Southern and some of its peers right now?
Well, we don't do buy, hold, sell recommendations, but at the end of the day, railroads are an important part of the supply chain. We all complained 3 years ago when we didn't have toilet paper on the shelves, and we kind of forget how important, railroads, trucking, air freight, marine shipping is not only to our overall economy, but our daily lives. The railroads provide a service where they're able to deliver and ship heavy freight at reasonable prices. So if you believe in the economy and you believe in their ability to run more productive over time, the railroads are an interesting investment case. And again, we don't pick out winners or losers, but from an industry standpoint, they have a lot of runway with regards to winning share from trucking, because the better they get at operating, the more truck competitive they can be. At higher fuel environment, they become even more truck competitive. And the railroads in the East, Norfolk Southern, CSX, are probably the most competitive or have the most opportunities for share gains against trucking, but they need to be able to operate at a very high level because those length of hauls tends to be much smaller than what you have in the West with Union Pacific and Burlington Northern.
Lee, can you just help me and the viewers wrap our heads around exactly how big the problem may or may not be? We saw this huge accident in East Palestine, and then we had another accident over the weekend. So I looked up the frequency of these, and I was surprised to learn that we have about over 1,000 derailments on average in the U.S. Every year. That's according to the Federal Railway Association, I believe, or administration. So is this common and it's just not, we don't hear about it, or is this more of a pervasive problem because we've neglected infrastructure and this needs to be solved yesterday?
Yeah, well, so everyone can do better, right? I mean, I can be a better analyst, they can be a better railroad, we all can do better. And I think this is an opportunity for railroads to do better. You're right, that number, it's about 1,000, about 900 of them are from freight railroads and 200 are commuter railroads. And the main reason why derailments happen is because of track failure, not the issue that happened in East Palestine. The issue that happened there, doesn't happen as often. The problem with this particular accident, it is obviously very horrific because of the environmental impact, not only to the residents of East Palestine and surrounding areas, but obviously the wildlife and everything else. So it's a real issue, and it's really highlighting the accidents that can happen. And so they're going to make these investments. They're going to make these investments, and again, it's $40 million with a CapEx budget of $2.1 billion that was expected this year. So, we're not talking about a huge amount of outlay for the railroad in incremental gains. And this is what it's going to be. If they can prevent one or two of these every couple of years, it's a win for everybody. They're also investing in kind of future technologies that use cameras, and a train can go through these portals, and there's cameras constantly taking pictures. And not only are they looking at the axles, but they're looking at everything. They're looking at the locomotive, they're looking at parts of the cars, and they can tell you what kind of failures might be coming up, so they can take that rail car or that locomotive off and schedule for maintenance. Mm-hmm. And so that's going to be a real game changer. There's they're slowly bringing those out because the technology maybe is not perfect yet. Those are a little more expensive. Those are about $15 million a piece. But again, when you're looking at a CapEx budget of $2.1 billion, it's not that much. Mm-hmm. The railroads generally spend about 15% of their revenue on CapEx, and about 80% of that is just on maintenance.
Yeah, I'm not surprised by that figure, and a ray of optimism for the future here. Really appreciate you breaking all that down. Bloomberg Intelligence Sector Head and Senior Analyst Lee Klaskow. Now, imagine losing your life savings due to an account hack. And that's exactly what happened to Jared Ferguson, no relation. He says $96,000 was stolen from his Coinbase account, and he's now suing the crypto exchange to take responsibility for the unauthorized withdrawals. But the company has refused to reimburse him. Yahoo Finance's Alexis Keenan has the details. And Alexis, I got to say, I've seen a few of these happen with broker dealers, and that's kind of the line for these brokers is that 2FA, any kind of authentication is on your end.
That's right.
And this is maybe consistent with that?
And that's Coinbase's argument here, we suppose. We've seen it before. This is not the first time we've seen one of these lawsuits, but some of the claims that this plaintiff is making, Jared Ferguson, are perhaps a bit novel. He's making both state and federal claims, a bunch of them, 4 of them to be exact. And he says that Coinbase is willfully making itself blind to a confluence of factors that should tip it off to knowing that these transactions are likely fraudulent. So let's go through them. This is the way that the complaint states it. They said take a look. This is out of character for Ferguson's account usage. The account was drained. It happened within 8 hours' time, occurred on a new device that had not previously been associated with his account, happened with a new IP address, also occurred immediately after a new password had been reset, and also without previously activated facial recognition that he had set up. Now, we've reached out to Coinbase to ask for a response. We've not heard from them yet, though I have been covering these cases for years, talking to plaintiffs, victims of these types of hacks for years. And when I last spoke with Coinbase's chief information officer, he had said, look, it is getting more and more difficult for people to secure their personal information with so much online. So it seems that there's some recognition, at least going back a couple of years by the company, that they do know that it's tough for people to keep their private information private. But how this particular hack happened and how this money was drained is the way that it's drained for many, many consumers. And that is by a SIM swap. And that is when the hacker goes and is an imposter posing as the account owner of a mobile device. And so they are able to put in a new SIM card, get it swapped out by the mobile carrier. And this has happened across mobile carriers too. This one happens to be a T-Mobile customer here, this plaintiff, but it has happened across all of the carriers in the US at least. So look, this is a trouble for both the mobile carriers as well as crypto exchanges. We'll see if this lawsuit has some legs. It does raise some novel arguments.
Yeah, and it also seems like, bottom line, everybody needs to improve their security.
Yes.
Like both on an individual and these companies.
AI should be disrupting this in the very near future. All these flags. I mean, you would think. And, you know, anybody who loses that amount of money unnecessarily due to a hack, my heart goes out to them because trading is hard enough. Trading is hard enough.
I have talked to many consumers who have lost millions, and not to say that that makes this 96,000 any smaller. This plaintiff's, he says it's near his life savings.
Yeah.
Alexis, thank you. Appreciate it. Coming up, Rochelle Akufo has you for the next hour of trading, including a conversation with former House Transportation and Infrastructure Committee Chairman Peter DeFazio in the next hour. Keep it right here for that. And, of course, continued tracking of Jay Powell's testimony, which continues to move this market.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. Stocks fall as Jay Powell says rates are headed higher than expected. He also touches on crypto and bank capital buffers. We're across all the action as the Fed chair kicks off his two-day congressional testimony. And Norfolk Southern outlines new safety measures in the aftermath of a second train derailment in Ohio. Are the plans too little, too late? We'll ask the former chair of the House Transportation Committee. And the Senate is set to unveil a bipartisan bill that aims to restrict access to TikTok. It comes as China's new foreign minister strikes a tough tone with Washington. We'll talk bilateral relations and trade. But first, let's check in on the major indices 90 minutes into the trading day. As we saw there after we heard those tougher comments from Powell about the pressures from inflation running higher than expected, we saw the Dow, the S&P and the Nasdaq all start to take a dive. The Dow here off by about 288 points, about 0.8%. The S&P, they're also losing ground, down 1% on the day, down 40 points. Tech-heavy Nasdaq, though, faring better at least than the S&P is, down about 98 points on the day. Let's also check in on the Treasury market action as well to see how they've been reacting. Of course, some of that flight to safety, at least for short-term yields, helping the 5-year there up about 0.7% on the day. The 10-year, though, down as we see 0.23%. The 30-year also down as well, despite the 10-year hitting that 4% mark yesterday, making some retreats so far this week. Right, well, to our top story today, Fed Chair Jay Powell making it clear interest rates will go higher for longer as economic data indicates a still strong economy. But environmental, social governance and debt ceiling fears also linger. Joining us with more, Yahoo Finance's Jennifer Schonberger. So Jennifer, Powell just responded to comments from New Jersey Senator Bob Menendez about the debt ceiling. So what's the latest?
Hey there, Rochelle. That's right. Q&A underway right now for Fed Chair Powell's semi-annual testimony today before the Senate Banking Committee. In a Q&A just moments ago with Democratic Senator Bob Menendez, Powell was asked about the consequences of failure to raise the debt ceiling. Powell saying there is only one solution here, and that is that Congress needs to raise the debt ceiling. Consequences would be, quote, adverse. He stayed away from getting mired in the back and forth between Republicans and Democrats over this spending fight. Now, in a separate Q&A with Republican ranking member Tim Scott, he pressed the chairman on reviewing bank capital requirements. Scott, along with other Senate Banking Committee members, have been tossed up over the Fed Chair, Barr's comments on holistic review of capital requirements. Scott saying that he's been troubled by Barr's comments recently that the banking system was resilient when it came to the pandemic. Scott asking Powell if he would commit to any ongoing capital requirement review, that should follow the law, be risk-based, and tailored to institutions' complexity. Powell saying, yes, I can easily commit to that. We are strongly committed to tailoring rules, which is not just a long-held principle, but a requirement under the law. Now, Scott also asked Powell about a letter that he, along with House Financial Services Chair Patrick McHenry, sent to SEC Chair Gensler about rescinding ESG requirements. He asked, do you agree that the Fed doesn't have the authority to use monetary policy to wade into ESG policies? Powell saying yes, and also saying that he would not use the Fed's policies to become a climate maker. I am monitoring this hearing and will bring you breaking comments as they come. Back to you.
All right. Thank you, Jennifer. Thanks so much. Right, well, let's turn now for a look at how markets are reacting to this latest Fed commentary. Joining us now is Yahoo Finance's Ines Ferre. Hey, Ines.
Hey, Rochelle. So you mentioned the markets earlier. We saw that equities open near the flat line. They are lower right now, but we're taking a look at the U.S. dollar index and how this has reacted to Fed Chairman Powell's comments. Take a look at the U.S. dollar index going up to 105.31. It was at 105.07 just earlier on. So as the dollar index rises, as the dollar rises against other currencies, you are seeing pressure on assets, on commodities. I also want to point out what's happening happening with the bond market, because we've seen the inversion of the yield curve even getting worse. So if we take a look at the 2 and the 30, that has blown past 100 basis points. You're looking at the 2-year yield now at 4.96%. You're looking at the 30 at 3.88%. That's a psychological level when it comes to the yield curve inversion. And we're also taking a look as well as the markets, as I had mentioned earlier. We're watching the Dow that's down 0.7%, the Nasdaq down 0.6%, the S&P 500 down 0.8%. And then if you look at the sectors when it comes to equities, the biggest losers being materials, financials, real estate, sensitive to rates. Rochelle?
Indeed. And Inez, of course, we're also watching markets reacting to political hawkishness and rising tensions between the US and China. Tell us more on that.
Yeah, that's right. Those comments from President Xi regarding the U.S. and China, that's really taking a little bit of a hit when it comes to the markets. We're watching the Chinese ADRs, and these have taken a hit over the last month, really, because of what's happening in China, the recovery there. BABA down 15%. Over the last 3 months, you can see the action when it comes to these ADRs. But what I really want to take a look at are also commodities, because the markets are not only reacting to those comments about tensions, more political tensions between the U.S. and China, but also reacting to the import-export data that has come out of China being weaker than expected, despite the recovery, despite the reopening in China. So if we just take a look at the commodities right now, we're watching WTI that had been higher over the last 5 sessions. Well, today, WTI down 2%, trading just above $78.80 per barrel. We're also watching Brent crude lower, down 1.7%. And just to note what's been happening with oil, it's been trading at in a range bound, about $10 range bound since the beginning of the year, since the end of December. Natural gas seeing a little bit of a bump today after it fell yesterday, but also taking a look at copper futures, because remember that China is the biggest exporter of copper. Copper futures down 2%. As that data has come out of China, the import-export data weaker than expected, there are concerns about demand going forward. Of course, concerns of a recession in the U.S. and Europe as well. Rochelle?
Certainly makes sense as to why we're still seeing markets searching for some direction at the moment. A big thank you there, Inez Ferre. Well, a programming note. We'll hear more about escalating tensions with Derek Scissors, a member of the U.S.-China Economic and Security Review Commission, later on this hour. Well, a second derailment of a Norfolk Southern train has raised the volume about whether U.S. transportation has grown too big too quickly, as fears that consolidation will flatten regulations grow. Joining us now is Peter DeFazio, former chairman of the House Transportation and Infrastructure Committee. Thank you for joining me this morning. Now, we know that Norfolk Southern's CEO is going to be testifying on Thursday before the Senate panel. And also, of course, just this morning, a conductor for Norfolk Southern killed in a collision between one of their trains and a dump truck as well. We know this is clearly at the forefront now, but give us some context into the position that this puts Northern Southern in when you figure in the number of derailments and accidents that do happen on a regular basis in the U.S.
Well, this has all been evolving over a number of years because of something called precision scheduled railroading, running trains of excessive lengths, cutting back on maintenance and crews and that. We could really spend a lot of time on this topic. It's been something that I've been critical about for about a decade. And it's time that the feds, both at the Federal Railroad Administration and the Surface Transportation Board, we're given new tools by Congress to rein in what's going on in this industry. The freight industry has become a mess.
So then why do you think we didn't see more action on this, getting this reined in, getting more focus on making both the tracks and the trains as safe as possible?
Well, I had to deal with their customer abuses last year. I had a bill to give new tools to the Surface Transportation Board. All their customers are very upset about the poor service, the excessive costs, and the new fees that they're charging. And I couldn't get a single Republican sponsor. They have had inordinate political clout, particularly on the Republican side of the aisle on Capitol Hill.
And so we know in terms of the response from the actual operators themselves, Norfolk Southern released this 6-point safety plan in response to the accidents. The National Transportation Safety Board really highlighting one of their points in particular, enhancing the hot bearing detector network. Now, Transportation Secretary Pete Buttigieg said it's a positive start. It does not go far enough. What do you think is still needed at this point? And what's your reaction to this safety plan?
We're using very primitive technology here. The braking system was invented in the Civil War era. The hot box detectors to find failing wheel bearings are not regulated, and they're quite primitive. You should have vibration detectors, real-time vibration detectors, which could get to bearings long before they're getting to the point of failure, so you wouldn't have these massive derailments. This industry needs to enter into the 21st century. They won't do it willingly because it might hurt their stock price if they made these safety investments. So the feds are going to have to push them.
And Secretary Buttigieg did say the operators, obviously they can do more voluntarily, but what are some concrete steps that you think Congress can take right now?
Well, they could pass the bill I introduced last time to deal with the customer abuses. That would help because that's driving up the costs for consumers and hurting the economy. And the Federal Railroad Administration could use more authority to deal with this precision schedule railroading having to do with train lengths and other issues. So Congress should begin with some really strong oversight and then pass legislation in both those areas to help the administration deal with this. Right now, the administration doesn't have the greatest tools.
And speaking of regulation, I want to shift gears now and talk about what we're seeing in the aviation space. We know that antitrust regulators are preparing to file a lawsuit to block JetBlue's $3.8 billion bid for Spirit Airways. And this is over competition concerns. JetBlue CEO is saying this is actually going to help with competition against the big four airlines. How do you view this?
Look, I've opposed the big four mergers. Where was the Justice Department when Northwest, Delta, Southwest, AirTran, United, Continental, American, US Air? They weren't there. So now the big four are a huge dominant force in many, many markets across this country and have very little competition. JetBlue, taking over Spirit now, which is an ultra low cost carrier, and converting it into the JetBlue model, which has what's called the JetBlue effect, would allow them to compete with the bigs for a different market share. The ultra low cost carriers, Spirit, Allegiant, and others are, generally going for the leisure market and to save for consumers. Now, Justice is saying, well, we're concerned. Well, Allegiant and others can pick up the ultra low cost market and continue to provide that service. This would provide a competitor to the full service airlines, to the big four. And Justice has already noted in the past, and they say, quote, a long and public track record of significantly lowering fares when JetBlue enters a market, terming it the JetBlue effect. So this is an anti-merger to deal with the past, mergers that Justice didn't successfully oppose or didn't oppose at all.
So essentially trying to close the door after the barn door after the horse has already bolted. So then what about for consumers then? Is this something that they actually want? Then does it really benefit them in the long run to now have this fifth large company as well if this merger goes through?
Well, it's a different model. And they, as I said, the JetBlue effect, when they come in, the big four have to lower prices to compete because they're offering services that ultra low cost carriers do not offer. They have wider seats, they have full service, they have different classes on the planes. And that would bring in a fifth competitor. When you got five major airlines competing, I think that will benefit consumers on many of these now captive routes and these captive hubs, these fortress hubs. And like I say, there's lots of room for more growth in the ultra low cost carrier market with other participants. So I don't think that this is going to hurt consumers. I think that the leisure travelers will find plenty of options with Allegiant and others. but then business and more, less cost conscious people will find JetBlue has opened up their markets, whether they're in Philadelphia, Detroit, Houston, Baltimore, Washington, Chicago, or any of these places that are dominated by one or two airlines.
And certainly everyone could use some discounts right about now when we look at where airline prices are at the moment. Peter DeFazio, thank you so much. Former chairman of the House Transportation and Infrastructure Committee. Thank you for your time this morning. All right, coming up, Meta planning to launch its first true AR glasses in 2027. We dive in to see if the tech giant can remain on track for its year of efficiency while also trying to push for an augmented reality. Stay tuned. The tech layoff wave ensues, with Meta reportedly set to cut thousands of employees as soon as this week. That's according to Bloomberg. Now, this comes after the Facebook and Instagram parent company saw a 13% reduction to its staff late last year. Now, Meta's additional layoffs comes amid efforts in achieving its year of efficiency goal. However, layoffs continue beyond Meta, with more than 125,000 in the global tech sector employees laid off since the start of 2023 alone. That's according to data compiled by the website Layoffs. Now, FYI data suggests that the 2023 is firmly on pace to surpass 2022 for global tech layoffs, as it ticked up almost fivefold since mid-January. As Meta seeks cost-cutting measures in its year of efficiency, it remains focused on its push into augmented and virtual reality with investments in consumer hardware. May this put a dent in the tech giant's efficiency efforts, though? Here with more is Yahoo Finance's Dan Howley. So, Dan, what's your take?
Yeah, Rochelle, this is something that we're seeing Meta kind of obviously uses a theme throughout the year. You mentioned their Mark Zuckerberg's statement calling 2023 the year of efficiency, where the company will go ahead and try to cut costs as much as possible. They're doing that with middle managers. We're seeing these reports of potentially thousands of layoffs. That's in addition to the 11,000 positions that were eliminated previously in November. So, for the augmented reality and VR effort, Mark Zuckerberg basically said, look, we're going to continue to push into this, but the majority of their spending will go towards their primary products. And I think that's a good distinction to make. The VR side of things, the AR, the metaverse, that's still losing money. I believe it was $13 billion last year, or $10 billion the year before that. So the spending increased dramatically, but you have to imagine that at a certain point, if the numbers don't bear out as far as sales go, and we're starting to see, potentially we'll see new devices come out in the next year, then we'll start to really get a sense on where this is going. You know, we did see the report from The Verge about Meta's 4-year plan going from the the upcoming Quest 3 headset, as well as the eventual hologram-style glasses, where you'll be able to project, super photorealistic holograms onto the real world. That's expected to come in 2027, if it comes at all. And I think for most people, the thing to look at is, again, in that Verge report, the VP of VR said that newer buyers aren't sticking around with their devices as much as original buyers. In other words, the early adopters still are true believers, while the people who went out and bought after are basically saying, meh, that was cool for 5 minutes and moving on. So you have to wonder what that means for the long term, because it's not going to be the hardware sales, it's going to be the software sales that really helps boost Meta here. And if you don't have a lot of users, you don't have a lot of software, you don't have a lot of ads to sell. So I think this is going to continue to be something that we'll be watching and figuring out where the sales end up as these newer iterations of headsets come out.
And as we speak of some of this belt tightening and being more strategic, Google also out with a warning on its promotions to more senior levels. What can you tell us there?
Yeah, this is basically Google, parent Alphabet, kind of, again, cracking down on spending, similar to what we saw, or what we're seeing at Meta. They're trying to pull back, basically, according to these reports, warning folks that they won't be getting as many promotions as they may have, or parts of the company won't be getting as many promotions as they once had into the kind of senior ranks. And that's basically their way of kind of trying to cut back on costs. Google having a decently hard time of it with the ad space, especially in YouTube. And so, they're trying to catch up. They're dealing with all of these myriad issues with antitrust. Ditto Meta and Amazon for that matter. But, when it comes to Alphabet, I think the bigger issue is where YouTube sales, ad sales are going to be, and then obviously where the overall sales are. And then, there's the whole morale within the company when it comes to how they're trying to kind of combat Microsoft and their own upstart Bing with that ChatGPT chatbot. So, didn't really have a great rollout or a big debut for Alphabet. You have to imagine this doesn't really help with the morale there at the company.
Indeed, a tough time in the tech space continuing. Dan Howley there, thank you for that update. All right, well, let's check in on the markets here, sponsored by Tasty Trade as we head into the middle of the show here. All three in negative territory here. The Dow is touching session lows at the moment, off more than 300 points on the day, down about almost 1%. The S&P there also down 1%, losing 40 points. Tech-heavy Nasdaq there also down about 91 points on the day, ever since those Powell comments really showing that these interest rate hikes are going to be higher and for longer, really putting some nervousness back in the market. So we'll be keeping an eye on that for you. All right, coming up, work are reshaping how U.S. companies look at foreign employees. What the latest immigration trends look like for 2023. Next. High-skilled foreign workers are in high demand in the US, with 87% of employers looking to hire. But the country's immigration barriers are pushing many to outsource overseas, according to a report out this morning from Envoy Global. CEO Dick Burke joins me now to discuss. Thank you so much for joining me this morning. So obviously this is a very difficult time at the moment. You have a tight labor market, seeing a lot of tech layoffs as well. Talk about the difference of what you're seeing with H-1B visa holders versus other foreign nationals in the US.
Certainly. Well, thank you for having me, Rochelle. We're seeing much of what Dan talked about in the prior segment. Interest rates increase. Tech companies need to tighten their belt. They let people go. 78% have frozen hiring. 52% of our respondents went through RIFs, pretty equally impacting H-1Bs and green cards. And the challenge is that with three things coming together are making foreign destinations much more attractive. The confluence of still a very tight STEM market. STEM unemployment is only 2%. Take that, take challenges with the US immigration system where there is just not enough spots to go around, and take employers' comfort with remote work. And we saw a very pronounced increase, Rochelle, in this, our 8th survey, of companies moving folks overseas solely because of problems with the immigration market in the United States.
And as we look at your data here, 94% of companies would sponsor more foreign employees if there were fewer immigration barriers here. So talk about the key barriers that are really preventing this hiring right now.
Certainly. Well, there are two principal ones, Rochelle. The first is a cap on supply. H-1Bs, which is one of the sort of the bread and butter for employment-based immigration in the United States, 85,000 issued a year. For the last 3, 4, 5 years, demand has outstripped supply by 3 to 1 or 4 to 1. Green cards are similarly capped. That is the ability to stay in the United States permanently and work. Those are capped. And because of demand, certain foreign nationals, principally those from India and China, have to wait 10 or 15 years. So the first big problem is a lack of supply, and a supply that cannot keep up with demand. The second problem is processes which are still deemed by employers to be too slow, too analog, particularly compared with those in foreign jurisdictions. Interestingly, many of these employers said we will pay more, but we need more spots, and we need to get more quicker resolution.
So how much of this is about the tight labor market and inflation and other things versus the skills gap and then having to pay these higher wages as well?
Well, it is a very thoughtful question, and it's both. We know the STEM unemployment rate is 2%. It has not budged, notwithstanding all the headline news about Meta and all the other companies that have engaged in freezes and layoffs. So that's one problem. And the second problem is other jurisdictions are catching up with the United States. They have the rule of law. They have good universities. They have proximity to the United States. They have English fluency. And as a result, 80% of employers who responded, over 500 respondents, Rochelle, over 80% moved folks overseas because of challenges with the U.S. market, or opened up positions overseas, which they intended to have in the United States because of that supply-demand imbalance. And here you can see what those common countries are. You know, and the common threads are English fluency, well-educated, rule of law, et cetera.
And so what types of jobs are going overseas? I know there's a lot of focus on H-1B, but what are some of these jobs that are being outsourced right now primarily?
Certainly. Well, it is the whole range, and we can we've parsed through government data to see that they are obviously the standard bread and butter technology positions, but also companies in fields other than technology, Rochelle. It may be manufacturing, it may be finance, it may be insurance, it may be consultancies. All those jobs that require what the H-1B calls a specialty occupation, folks are moving to Canada, to Mexico, to the United Kingdom, to France, and to Germany because of this supply and demand imbalance. And the challenge we face as a citizenry is to have a discussion around how do we focus on this issue, take our eye off the southern border for a moment, and address this perennial issue of not enough slots to go around for folks that everyone seems to want to have in the country.
And you do have that dichotomy in the discussion of needing more foreign talent, but also obviously a lot of focus as this political football when it comes to immigration on the southern border. I do just quickly want to ask you, in terms of the tech layoffs and the rehiring of some of these foreign nationals, how is that looking at the moment?
Well, it's interesting. 89. We asked that question because we were very curious. We were just in market last month, Rochelle. 89% of respondents had hired a foreign national who had been subject to a reduction in force, which we were very happy to see. And it wasn't particularly surprising because the STEM unemployment rate has stayed so low, and such a large percentage of the STEM unemployment rate is foreign born that it was not a big surprise, but the 89% had been rehired.
Something at least good to see something positive coming out of this, despite a lot of the headlines about these tech layoffs. Dick Berg, a pleasure speaking to you, Envoy Global CEO. Thank you so much for joining me this morning. All right, coming up, Weight Watchers making the move into the market for diabetes and obesity drugs. We'll discuss what this means for the future of WW International. Rivian stock sliding as the company needs to raise more cash with a green bond offering. Pras Subramanian has the details. Hey, Pras.
Hey, Rochelle. So, Rivian stock taking a hit this morning as it will actually offer a convertible bond offering with worth about $1.3 billion with the additional $200 million they'll offer to original purchases there. So up to $1.5 billion there in the green bond. So what that means exactly is that Rivian will use the initiative, the funding for only green initiatives like clean transportation, renewable energy, energy efficiency, pollution prevention, things like that. That's what they'll use that money for. It kind of ties in with Rivian's ethos as a company that supports conservation. They've signed on to the climate pledge, among other things. So, and the reason why this is kind of important is because the company lost $5.2 billion last year on an adjusted basis, and it projects to lose around $4 billion more this year. So, with only around $12 billion in cash reserves and about $2 billion in capex spending planned for this year, it sort of needs to kind of build up a cushion there for its in future investments, and that will be that new factory in Georgia that will open in around 2026.
Certainly keeping an eye on that production. We know that was a problem for Rivian at the beginning, so it'll be interesting to see how they use that cash. Pras Subramanian, thanks so much. Right, well, Weight Watchers International is expanding into the obesity drug prescription business with the acquisition of telehealth platform Sequence. Its stock saw a huge move on the announcement. You see they're up 40% on the day. Yahoo Finance's Anjali Kemlani has the details. Hi, Anjali.
Hi, Rochelle. That's right. So this is an interesting move for Weight Watchers, which we know has put emphasis on natural processes, on food plans, as well as, just general diet and exercise over the years as a format for losing weight. Now, they're looking at a different segment of the population and noting in the statement announcing the acquisition that, quote, we know weight management isn't a one-size-fits-all, and clinical and interventions are not medically or otherwise appropriate for everyone. They also did tell the Wall Street Journal that they are intending to not prescribe this for someone who maybe just needs to lose about 10 pounds. So that's just, sort of a disclaimer on where this is going and how this changes Weight Watchers' sort of strategy and how they're looking to broaden the customer base that they're looking at. We do know that the telehealth platform does cater to and does prescribe some of these new drugs that have been prescribed for weight loss, even though they're originally maybe for diabetes or other types of illnesses like high cholesterol and the like, all part of what does impact weight. So this is where it sort of starts coming together, looking at really finding synergies here, and this is where it makes sense for Weight Watchers, but it is a different strategy and an interesting strategy. It does gear more clinical than what the traditional Weight Watchers has built its brand and reputation on. Currently, Sequence has about 24,000 members across the U.S. and will be all part of Weight Watchers shortly.
And it's interesting. I mean, I've been doing Google searches on a lot of these weight loss drugs for a lot of these segments. So now I'm getting bombarded with all these ads. Some not from doctors, though. Some from like private clinics with a lot of these weight loss drugs. What should people really be aware of when they're seeing these ads and really getting targeted by them?
Yeah, well, that has been part of the concern, right? There have been online platforms, telehealth platforms that can prescribe these, and there have even been celebrities who have acknowledged that they are taking these drugs for that little bit of weight loss. So it really is interesting. This is not necessarily what they were designed for, and so it just goes back to broader availability of prescriptions that don't fit the original intention, and just being cautious when using it for something that's not necessarily the original intent of that drug. I think that would be sort of that consumer warning on that. But outside of that, it is gaining popularity, and that has been the concern for these drugs.
Yeah, certainly important not to look at it as a quick fix. Make sure to read all the small print, especially for the side effects and things. Yahoo Finance says Anjali Kemlani, thanks so much. All right, coming up, China's new foreign minister says relations with the US have left a, quote, rational path. So are US-China trade relations going from bad to worse? We'll discuss next.
Consumer confidence decreasing for the second month in a row in February. The index falling to a 3-month low on worries over a possible recession.
A decline entirely driven by expectations for the future. That means U.S. consumers keep feeling better about today and worse about tomorrow. We've got to talk about retailers, too. They're remaining cautious as inflation weighs on consumers.
We're just seeing a consumer that's making choices as they've seen the persistent inflation in a category like food and beverage, and that's taking a bigger piece of their share of wallet, and that's factoring into their purchase decisions.
I was at Costco this weekend, and let me tell you, those lines were incredible. As the consumer continues to gravitate and stick to those where value is everything for the consumer right now, they're looking for any way to save a penny.
Disinflation, like the Fed is out there talking about, is not necessarily happening. These companies are still dealing with high levels of inflation in their supply chain, and their customer base still dealing with high levels of inflation.
It's also a very bad macroeconomic situation right now where the consumers have shifted their spending. They're moving away from discretionary and sticking to staples. As a result, it's not the best scenario for the department stores in 2023.
I think the premium, the wealthier consumers are still doing well, and they're still pricing up, so to speak. Whereas the middle income and lower income consumers are not only scaling back some of their purchasing, but some of the features, some of the add-ons, some of the more premium components of leisure spend are beginning to tail off.
The White House is considering detaining migrant families who cross the U.S. border illegally, according to the New York Times. Now, this comes as the Biden administration prepares for the end of the public health order Title 42, which allows agents to turn away certain migrants crossing the border. For all the details, let's bring in Yahoo Finance's Rick Newman. Hey, Rick.
Hey, this would actually be a return to the Trump-era policy, so Biden's getting some flack for this. But the problem is there's no good answer with regard to what to do to the migrant crisis on the southwest border. So on May 11th, the national emergency related to COVID is going to end, and that is going to change the ability of the Border Patrol to send people back over the border. Now, Biden has had a different policy in place, allowing some people to come across and settle with families or people they know in the country, but they're anticipating a surge of migrants starting around May 11th, so they have to do something about that. And they're floating this idea. This is not yet an actual confirmed policy, but they're floating this idea, I think, to figure out how much backlash are they going to get if they do actually go back to the Trump policy of turning people away at the border.
I mean, certainly an interesting sort of turning point here for the administration that was very critical of what Trump was doing there. Also want to talk about China, something that was also high on Trump's radar. China's new foreign minister, though, is sending a stark warning now to the U.S. What's happening there? Yeah,
this was a new minister, foreign minister taking office, who gave a long press conference yesterday and said the U.S.-China relationship is breaking off through the guardrails. So very strong language here. Now, this is it is true that U.S.-China relations are becoming much tenser, and there's also a rhetorical war with each side trying to describe what's going on. So a couple of the things Biden administration is doing: very tough new export controls on technology. U.S. technology going to China basically meant to block advanced semiconductors from going into China, semiconductors that could be used for weapons. At the same time, China has allied itself more closely with Russia, which of course is waging that war in Ukraine. And there has been some concern that China may actually begin to send Russia weapons that it could use in that war. So clearly the United States and China are facing off against each other more than they have. Now, at the same time, I would point out that trade between the two countries is still huge. We are almost back to record levels of trade between the United States and China. So the goods are still flowing. That has not been disrupted, but the talk is getting a lot angrier and more tense. So there's a lot to watch here.
Exactly. We're keeping an eye on sort of the domino effects from that. But as you mentioned, though, trade's still strong between the two world's biggest economies. Thanks so much, Rick Newman, there for us. All right, well, for more on this, let's bring in Derek Scissors. He's a member of the U.S.-China Economic and Security Review Commission and the chief economist of the China Beige Book. Good to see you, Derek. So talk about this dynamic that we have right now. Obviously, it's something of a combative relationship. The relationship seems to have gone, at least since Biden came in, almost non-existent, since there wasn't really a strong China policy. Where are things now?
Well, there's certainly, I agree with the report you just had, that there's a lot of rhetoric clash between the U.S. and China. the Chinese warning just now was to try to alarm people in the Biden administration in the U.S. that things are out of control. They're not out of control. The U.S. has passed, for example, interim rules, not the final rules, controlling U.S. semiconductor exports to China. The idea that if the U.S. doesn't export advanced semiconductors to China, that this is some sort of horrible relationship break is, of course, ridiculous. That's not an obligation. What we're having on the U.S. side is a lot of talk. The bipartisan consensus is to talk tough on China, but very little action. There's a lot of U.S. money flowing to China. As you said, the trade relationship remains very strong. So maybe rhetoric will lead to a different relationship, but right now it's almost all talk and very little action behind it.
And they do seem to be talking through policy versus talking directly with each other. Obviously, weren't able to have that face-to-face meeting with President Xi. But as we've just come off the two sessions, I mean, you have this 5% growth target that China's set. What does this really mean in terms of China's resilience and it's really this hope for a reopening benefiting the U.S. economy and others?
Well, it's not clear to me why people think that China's reopening will benefit the U.S. It'll benefit, say, commodity suppliers to China. China is the world's biggest demander of commodities, energy, metals, food, you name it. More Chinese production usually displaces American production. So the nature of the reopening matters. Is it going to be a consumer-led rebound this year? There will be a rebound this year of some sort. Is it going to be consumer-led? The February trade data that we just saw says no, imports are very weak. It's early, but it isn't the case. China will do better this year economically than last year. How it does better is important for whether it benefits the U.S. We could easily see a stronger Chinese economy that really doesn't offer any benefit to the United States.
So then as we look at this relationship then, and we look at the possibility of what's being called, as China tries to portray, a U.S. conflict, what exactly would that actually look like in reality, given how interconnected these economies are?
Well, again, the Chinese are acting like the United States has some obligation to have enormous amounts of trade with them and send them money to support their advanced technology and give them the technology directly through exports. What we could see this year is, what has been talked about a lot, a step towards decoupling. So far, we have decoupling talk in both countries. Don't really actually have decoupling if you look at the numbers. So we're not looking at no one's headed at this point towards any sort of real conflict, even economically, much less militarily. But we could get more separation between the two. I mean, there are reports from American business that they don't trust Xi Jinping's domestic economic policies for good reason. He's not very friendly to the private sector. So if American businesses choose to do less business with China, you're going to get those very intertwined economies you mentioned separating. But that's not conflict. Decoupling is not a fight. It's just a separation. And these economies in any reasonable case will still be very intertwined at the end of the year.
And we know that obviously COVID had a lot of companies worrying about supply chains diversifying away from China. But as we see more of these allegiances between the BRICS nations, as you see China perhaps having more allegiances to India and to Russia as well, what does this mean for U.S. companies sort of stuck in the middle here?
Well, I don't, China-India relations are not that great. China-Russia relations are obviously pretty good, unfortunately. U.S. companies do have some hard choices. I have long been an advocate for U.S. partial decoupling from China, but I don't mean to say no one should think, and I don't think anyone does, that will be easy. You can't just all move to Vietnam. Vietnam isn't big enough. You can't all move to India because India doesn't have the right policies really in many situations. You can't all move to Mexico. Mexico's already pretty crowded with companies. So U.S. companies face a trade-off here where they don't trust the policy environment in China. They don't trust U.S.-China relations in the long term, but they don't necessarily have great alternatives, which means if there is a decoupling, it's going to be slow.
And so then as we have that outlook here for China's economy, obviously some tempered expectations with that 5% growth target. But what are your expectations for the year? And what does this China reopening story actually look like in reality?
Well, I don't think people are misinterpreting the 5% growth target. An outgoing government, which is what we have now, Li Keqiang giving way to Li Qiang. I mean, it sounds like they're almost the same person, but they're definitely not. In terms of being number two, as we expect, the outgoing government is not going to set a target that the new government would struggle to reach and make them look bad. They're not going to say, oh, I think we can hit 6.5% GDP growth, and then the new government comes in and doesn't hit it. They're going to set a target that China knows it will make, barring very strange circumstances like a terrible outbreak of COVID or something along those lines. So people shouldn't read that China thinks it's going to grow at 5.1%, 5.2%. they expect GDP growth in the upper 5s, maybe even over 6. And that's on a normal case. Better cases could be higher. The 5% is being misinterpreted as negative. Having said that, the start of the year, China's reporting some good data, some bad data. The start of the year is actually weak on the ground. It's going to take a while. And again, the question is this going to be a consumer-led rebound where the Chinese government can stand aside and not bother with stimulus because they're already over-leveraged, and you actually have revenge spending that people want, and you have a healthy rebound? Or are consumers frightened? They've been battered in China for 3 years, even longer than American consumers were battered by COVID, and they don't spend. And then China has to inject more money, leverage more, and you get a rebound, but it's much less healthy. We don't know that yet. We won't really know how Chinese consumers are responding until April or so.
And in terms of where the investment money is then flowing in China, with that in mind, then what are you seeing?
Well, people are hesitant. They're looking for signals out of the current National People's Congress that is occurring in China, that China will not just say, oh, we welcome foreign investment, but they'll actually act like they welcome foreign investment. And there's some counter signals to that. There are some language aimed at the private sector that, isn't very encouraging of private sector activity. We recently had yet another Chinese private sector CEO disappear, who is now, quote, cooperating with authorities, unquote, as if he had any choice in the matter. So people are looking at the NPC and the policies of the National People's Congress and the policies that will come out of it this month and next month for a cue. Foreign business would like to take advantage of a stronger Chinese economy this year, but they're not going to do that if they're being told, we only want your money for the short term before we drive you out, because we really don't like private sector competition. So they're weighing, there's going to be a short-term macroeconomic rebound against what is the National People's Congress going to tell us. I would say so far the National People's Congress has been discouraging, but that's going to depend on the sector that you're in.
We'll certainly be keeping an eye on that space, and especially once those meetings wrap as well. China Beige Book Chief Economist Derek Scissors, thank you for joining me this morning. All right, coming up, we check in on some trending tickers ahead of the noon hour and take a look at what to watch throughout the rest of the day. Stick around. let's check in on one of our trending tickers, United Airlines. The stock up 4% today, as after BNP Paribas upgraded the stock to outperform from underperform with a $70 price target. The stock is up nearly 40% year to date. Other firms have also recently weighed in on the stock over the past few months. Barclays and Morgan Stanley raised their ratings, and Goldman Sachs recently initiated coverage of the company. Quite the turnaround, as yesterday the stock was severely under pressure. Well, stay tuned to Yahoo Finance all day as our team will dive into the latest economic outlook with Michael Gapin, Bank of America chief economist, in the 3 p.m. hour. Then at 4 o'clock, IMAX CEO Richard Gelfond joins the show to get a sense of the movie industry ahead of the Oscars this weekend. And tomorrow, our team talks with the CEO of Grayscale, Michael Sonshine, for the latest surrounding the crypto market. Well, before we go, though, let's do a final check of the markets as we head into the noon hour. All three in negative territory. The Dow there under the most pressure, off almost 400 points now, down more than 1%, weighed down by Apple, Microsoft, and JP Morgan as well, weighing on the stock, weighing on that. We also see the S&P 500 down about 1% there, about 45 points, and tech-heavy Nasdaq there down about 88 points on the day, all weighed down by what we heard from Powell's testimony of keeping rates higher for longer. Well, that will do it for now. I'm Rochelle Akufo, but I will be back at 11 a.m. Eastern. Stay tuned to Yahoo Finance.